All right. Good afternoon, team. I hope you're all having a wonderful day. Can you all hear me? Is my voice good? My audio coming through?
Loud and clear.
Perfect, perfect. All right, team. So this session is going to be recorded. I want to give everyone a heads up. And in this particular session, we're going to be covering the materials within this course. Um, so we're going to go ahead and get started right away. This is a risk disclosure. I want to give everyone a heads up that no matter what you do, there are always going to be risks, especially in the financials market. So this course will prepare you to actively trade and invest in the stock market, and can also be used in other financial markets as well, such as crypto, Forex. So if any of you trade Forex, if any of you are good at trading Forex, then this works even better on Forex, because Forex, as far as I am concerned, is very price action based. No offer in our part in regards to the sell or purchase of any asset is implied as financial advice. We are not recommending you to take any to partake any positions in the stock market. This course is strictly intended for educational purposes. Material presented are all fact-checked and come from accurate sources, but do keep in mind, please, that they are not always guaranteed in accuracy to work every time. This means that none of this is promised or going to work 100%. One must acknowledge that all trading and investment involves high risk. There are no promises, guarantees, or warranties that all of this information will provide training to profit or result in losses. Trading is risky, team. Trading involves high risk, and that is how it offers the high potential reward. Risk management is one of the three central pillars to trading, along with strategy and psychology, which we will also discuss. Trading isn't about guessing. You need to study the market data and understand how the market moves. The tools you'll be learning are extremely important to understand, as they each provide unlimited trade opportunities and connect a key part of price action based trading systems. We're going to take a look into what I mean by that shortly. You'll never have to miss out, team. You'll never have to chase, and you'll never have to use emotions to cloud your decisions. This is why we are studying these price action based strategies, so that we take emotions out of the equation. Even if you have the best trading strategy, with the perfect trading psychology, without risk management in place, losses will start to add up fast. And we also know that it is impossible to win every trade. And this is very important to know, team. You can't win every trade. Losses are imminent. They're going to happen, and you have to be a good loser. You have to learn how to lose, so that you become a good loser. So please do remember to keep those trades that are losers under control by using the proper risk management tools studied in this course. And you need to be properly educated to be able to generate consistent profit revenue. Just as any other business, to be a successful trader has to be the result of excellent risk management. We're going to teach you how to properly manage risk and thrive well, knowing there's always an exit plan when things don't work out. And that is what we mean by cutting losses, team. We have to be able to cut losses. We have to be a good loser, just like how we are going to be good winners. You'll be given all the tools needed to succeed and thrive consistently well in the trading business. But keep in mind, traders, the success and failure of a trader is all based on how you as an individual behave and how well you follow those given rules. The discipline of keeping your emotions under control by following the rules of this business with tools such as, for example, stop loss limits, risk management, position sizing management, entry based on confirmed levels, can make all the differences between a successful trader and a failed trader. Um, Another very important factor another very important point to discuss is that trading is not about intelligence but emotional discipline, team. I cannot stress this enough. I know so many intelligent people that are suffering terribly trading, and that is because trading is not about intelligence but emotional discipline. Matter of fact, if you follow rules, you're going to do very well in this business. It's that simple. um, Having the ability to maintain principles and assessing those risk management rules at all given time is what will differentiate a trader who's been in this business for 10 years but is not aware or does not follow those principles and continues to fail, and a trader who's been in the business for only a year but was given the proper education as to why those principles are crucial. And that is my job here, team. My job here is to give you those rules and those principles, and make you a trader that'll follow principles and not depend on any other factors. My goal is to help you become a defined trader where you are constantly using defined inputs to trade rather than having to base it on randomness and emotions. So what is required for trading? Here are the right tools and services needed to trade. First, you're going to need this price action based course. Second, you're going to need a stable internet service. Um, Team, the reason why you need a stable internet service is because you want to see those candles as soon as they print. If you are a quick day trader and you have a bad internet, that is going to be an issue for you because you're going to miss out on you're going to miss out on data. And if your internet is going bad because you don't have a stable internet connection, that is even worse. So make sure you have a stable internet connection. Um, and you need a fast order execution platform. I do all of my futures, stock, and options trades on TD Ameritrade's Thinkorswim platform. If you plan to use that platform, we'll give you our script code that'll give you the same setup we have in a single click. We have tweaked the setup for years to make it as perfect and price action based as possible. You're also going to need a scanner for finding stocks with high smart money flow. We discussed some of the stock scanners in our live session today, and we're going to learn more and more in this course. Any stock gaining momentum should be observed for potential trade setup with the condition that momentum is present. Momentum is, I was discussing this in the live session today, and I was telling our members, I was asking them to see if they knew what is the most important influence or factor that'll increase your probabilities on the winning side. Well, to put you on the winning trades over and over and over. Well, that is momentum. When you understand momentum and you have a scanner for finding stocks, any stock gaining momentum will be the right trade to take. So make sure you are always following where momentum is, and if you don't know where momentum is or how to follow momentum, don't worry, we're going to study all of that later on. Very important to remember that trading is different from investing. We do not get attached to the positions, nor do we use the belief system that investors apply to their long-term stock picks. Any options contract or high volume stock we trade today is entirely useless to us tomorrow. Always remember to live to play another day, team. All right, please, to live to play another day. You can't put a price on this simple yet very crucial must-know analogy. If you survive the learning curve, then the good times will come and you can become a consistently profitable trader. But you have to survive. And many just can't because they don't know or don't apply the risk involved money management rules of this business. Above all, team, trading isn't about being right. It is a business of statistics and probabilities. It is a game of patience as we look for the right setups that offer great risk to reward opportunities. Losing should be normal, as we discussed, and managed properly and maintained. You must apply this component to all trades. So, starting out, when you begin trading, there are a lot of questions. With all of the information out there, it can be hard to decide where to start. Trading requires proper tools, software, and education to succeed as you compete with other traders for the best bid and ask. So, anytime that you are buying something, keep in mind that someone is selling it for you or someone is competing against you for that price. We have developed the perfect study guide to help educate traders about the proper tools utilized to become self-reliant. I can give you a stock and you win for a day. I can teach you how to trade stocks and you have gained the path to win every day and remain self-reliant, generating consistent income without the need for me. Team, the core strategy price action for the zones that I'm teaching you, that is going to make you self-reliant without the need for me to exist in your life. And that is very, very true. So we've given you 2 years of Discord access with the purchase of this program with the aim for our students to grow with us, absorb all of the data given in the study guide to execute trades accordingly. Our aim is to teach our traders price action from scratch to mastery level. You're going to utilize what you learn to find high probability and high quality trade setups. Once you master the skill of explaining the market, it is human tendency with the data given to be able to predict with accuracy where price action is headed next, and even if that is for 30 minutes. Team, here's our expectation for you. By the end of this course, you are expected to craft unlimited number of trade strategies using various price action-based trading systems. After you absorb our course, going forward, this is where you cut the guessing game and prepare yourself for proper trading. Our intention isn't to help you win for a day, but rather teach you how to consistently win every day and continue to grow that window of income. We educate you on the tools needed to understand the language of the market. You'll be learning how to read price action, where the momentum shines with smart money flow, and which side to place trades exclusively based on price action trading. We encourage all of the traders who plan to prosper in the stock market to work hard, study hard, and maintain discipline in all conditions. It really all comes down to whether you're serious about this business. All right, team. So here we are. Introduction to price action based trading. What is price action based trading? Price action is simply the study of price movement in the market. It is the naked form of price chart on your display without any additional indicators or studies. So when you're viewing candlestick charts on your phone or your computer, you're studying the pure form of price action and seeing the behavior and sentiment of the traders within those candlesticks. So what do I mean by that, team? Let's go take a look. Here is Microsoft. Here is Microsoft from today's trading session. These candles, team, these candles here that you see on our on the price chart, this is the naked form of price action without any data given, without any indicators. So um, when you're looking at price action and when you're studying the naked form of price action, you're looking at something like this with no indicators, with nothing on your way, just candlesticks. That's it. When viewing candlestick charts on your phone or computer, you're basically looking, you're studying the pure form of price action and seeing the behavior and the sentiment of traders within those candlesticks. So this candle right here, these candles right here, this basically represents the sentiment within within price action that traders feel at that moment, at that given time. So if the sentiment is bullish and the trend is going higher, and you have a break of structure, then price action is going to continue to increase higher. So for now, this is what you would see. You're going to see this naked form of price action. And this is what I want you to start off with. This is what you're going to start off with. And then we're going to apply all of the tools that we learn on this course and apply for our trades. So one of the tools that we will learn, for example, that we will cover later on is trends. So when you identify the break of trends, trend shifts and so forth, you can see that once a certain trend is broken, there is another trend in play. And this is what we are going to cover later on. But for now, just understand that price action is simply the study of price movement. You can choose any stock, you can pull up any stock, and without any indicators on your chart, when you're just looking at candlesticks, you're looking at the pure and naked form of price action without any modifications and anything there. You're just looking at pure price action. So what is price action trading? Price action trading is the ability to trade with no indicators to cloud your view of the asset price you're trading. A price action based trader focuses on the behavior displayed within the price chart, trading based on the actions of price sentiment at the given time. Candlesticks to traders contain the singular belief, knowledge, and all action of all participants involved. So what do we mean by that, team? Well, here is the naked form of price action. This candle here, this bullish candle, bullish engulfing candle that happened 5 minutes after the opening session today, this bullish engulfing candle that is a bullish reversal was the behavior of and the belief of all traders in the market. So all participants involved on Microsoft within that time, this was the behavior. And when this happens, this is a clear form of demand overwhelming supply, which we will cover later on. I'm trying not to share too much information. I just want you to understand for now that this is the naked form of price action. So when you're looking at something like that without any indicators, you're looking at pure price action. All right, so we're going to learn how we can trade price action through this course, team. So what does it take to be a price action trader? When prices are advancing higher, this is a clear implication buyers are in control at the given time. That's all you need to know. When the market is in a decline, sellers are exceeding the buyers, and that's all you need to know. No need to search anywhere else for why the market is reacting in such a way or what the bias was yesterday. Stick to that simple principle. Sticking to that simple principle is what describes a price action trader. So team, so far, do we have any questions about what it means to be a price action trader? All right, let's go on. So in this course, we're going to be covering 8 price action based trading methods. We're going to cover supply and demand and the formulas. So we're going to understand the concept of supply and demand, recognize supply and demand zones on your chart, execute successful trades based on our supply and demand formulas. And then we're going to cover candlesticks as pure trading signals. Now, keep in mind, team, all of these price action based trading methods, all of them within themselves can be traded individually. So candlesticks itself, the pure form of candlesticks, the naked form of candlesticks can be traded as pure trading signals. And we have some very efficient strategies and reliable candlestick patterns that we have for you. So learn to read. You're going to learn to read all price action. You're going to learn to read price action using candlesticks, analyze the anatomy of candlestick formations to craft unlimited trading signals using nothing but candlestick data. Learn all of the best candlestick reversal and continuation patterns found in price action with high conviction. We're going to cover all of that stuff. So actually, we're going to cover them. We're going to go over them one by one. Since this is our table of contents, we're going to cover them. So for supply and demand zones and the formulas, here is the supply and demand zones and its formulas. And this is what its formula looks like. So we're going to cover all of these materials. And then after we have covered the supply and demand zones formulas, we're going to cover candlesticks as pure trading signals. So what are candlesticks? Let's go take a look at what candlesticks are. Here are what candlesticks. So candlesticks are the bars that you see on this chart. It is these bars that you see on your chart. The naked form of price action without anything, without the moving averages, without anything clouding your judgment. And we're going to cover all of this as well, team. So for now, I just want to show you what candlesticks are and how we use candlesticks to trade. So there are various candlesticks. We're going to learn all about this information very, very soon through the courses, through the classes. All right, so next we're going to identify any market trend structure. Team, before we go ahead and explain market structure, I want to show you why understanding candlesticks is so important. So to basically to use supply and demand to its best benefit, right? We have been discussing how to draw supply and demand zones. Well, if we are going to learn how to draw supply and demand zones, we would need to know what the best candles are to be found within that zone when we are trading supply and demand zones. So let's go take a look at ABBV on the weekly time frame. So here is ABBV on the weekly time frame. If I draw my zone there, I'm going to want to know what candles are forming. Oops, sorry about that. There we go. So let's take a look at ABBV there. So the reason why, team, it is so important to understand candlesticks and all of the candlesticks, all of the reliable candlesticks that we are going to study is because when you find zones, when you're trading these zones, you're going to want to find the right candles that tell you what is going on. So if you get a bearish, let's take a look at today's trading session on SPY. So for today's trading session on SPY, we're going to take a look at some candles that that gave out the signal for us to go long confidently. So here is today's price action for SPY. And if I draw a zone here, if I draw a zone right here, if I draw a zone, what told us that we were going to get a breakout was this bullish engulfing there. Once you get a bullish engulfing right there, and then you get a confirmation with another bullish engulfing, this gives you the confirmation to go long because the candlestick, that's what the candlestick anatomy tells us, which we will study later on. So the reason why we need to learn all of the candlesticks is because of this, and they can be used without this. So I can throw supply and demand zones away, and I can simply just trade off of bullish engulfing. So this bullish engulfing, I can trade it as soon as we had a confirmation there, and you will learn all of this stuff later on, I promise you. So I don't want you to be overwhelmed. We have all of the candlesticks. We have all of the reliable ones on the bullish and the bearish sides. So then you're also going to identify any market trend structure. So why is it important to identify any market trend structure, team? And how do we identify the right market trend structure? Well, the way we identify it is the same as candlesticks. When we know which reversals happen at which, because we have the illustrations for it, then you're going to know exactly when a reversal takes place, and when a reversal at a key level market trend structure takes place. So what is identifying trend structure? Well, it is in this way. Is it in an uptrend? Is it a downtrend? What is the trend doing? Or is it simply moving sideways? Are you trading the impulsive or the corrective wave? Recognizing structure of trends give you the ability to predict and prepare high quality trade setups strictly based on price action based trading strategies. So what is it to understand whether the market is in an uptrend or a downtrend or sideways? What are the characteristics? How do we know all of that? We're going to cover it later on. And believe me, we will cover it up to 100%. This is a topic that we are very well informed and practice it every day to find high quality trade setups. Support and resistance. So we have discussed what support and resistance levels are, and we have gone as far as giving clues or not giving clues, showing our team how to identify or how to pretty much how to identify a support level being created, not established, team, and not confirmed, being created, which means you can now tell the origin of a support or a resistance level just based off of supply and demand zones. And we will discuss that later on, because supply and demand zones and support and resistance levels go hand in hand and are derived from one another. Learn the concept of support and resistance, how to draw support and resistance levels, and the best high probable times to trade them. This method will give you and help you enter and exit any trade in the right time. The levels will give you a place, will help you place a rational trade execution and assess proper risk. Trade executions. Through our illustrations, you're going to learn to successfully pinpoint trade entries, exit, and profit target levels in the right frame of risk to return ratios. We're going to take a look later on. Once we get to those parts, you will notice that every single trade that we take is going to have a firm entry, a stop loss, and profit targets. Risk management tools. This is one of the most important aspects of this business. Managing risk is one of the most crucial key components in this business. Every trader should understand in full concept before trading. The market is not always about winning. You can win 9 trades and lose it all in one failed trade out of the 10 due to lack of proper risk management. So how does that happen, team? Well, a trader will end up making nine trades, right, and winning all of them using the same strategy that he or she always applies, which is buying one contract. And then all of a sudden, one trade goes wrong, and they decide to add crazy size, adding 9 contracts to it. And now all of the sudden, their risk is amplified 9x, and that is a huge lack of risk management, and will result in devastating blowouts. So make sure you are following make sure you are understanding risk management before you start trading. Make sure you do not trade first as soon as you get into the market. You want to paper trade, you want to study for a while. And when you're paper trading, you don't want to paper trade just because you have unlimited money. You want to paper trade in a way where it fits it fits the amount of money that you're going to add to your account, and the principles that you're going to follow on your real account. If you don't do that, then there is no point in practicing a paper trade account. Moving average lines. So we're going to study and learn about the moving average lines and share our core strategies on the moving average lines. You're going to learn particularly about the 200 moving average line, which will provide you a mini map view of how far out the trend structure is extended from the home base. Smart money institutions and algo traders, investors have long used moving averages to determine trends in the market to buy low and sell high. And last but not least, we're going to cover chart patterns and trend lines, learn all of the aspects, all of the powerful chart patterns that provide high quality, long, and short trade setups. Chart patterns represent the structure and predict the impulsive and corrective waves. Chart patterns representing trend structure also help traders place the right levels of trade execution at the break of a structure in case things go wrong. So the reason why chart patterns are important is because they show us the visual chart patterns basically represent the visual structure of trends. And that's what, in simple terms, that's what they illustrate. So we're going to take a look at that later on. We're going to study all of the chart patterns as well. And yeah, team, I am very, very excited for this. We're going to cover much more than these 8 price action based strategies, but these are the core strategies that we will be studying in this course. All right. So, wow, we are already in supply and demand zones. I wanted to go a lot slower, but if we have to go fast, we're going. I mean, if we, if we are going at the pace that we are, and we are covering materials, that's perfect. We'll take it. So, introduction to supply and demand zones, team. What are supply and demand zones? What forces drive market prices? Well, it's supply and demand zones. The stock market is a double auction market where the forces of supply and demand are in an endless clash for control. The concept of supply and demand works the same way in the stock market as it does in any other financial asset. Supply and demand is the primary factor that determines the price, but there are various factors that influence supply and demand traders must know. Our expectation in this course is to teach you all about those tools. So what are supply and demand? Supply and demand are the driving forces behind price movements. Supply is when the sellers exceed buyers, causing price action to drop. Demand is when the buyers exceed sellers, causing prices to rise. A demand zone is a price area where there is strong buying interest. In a demand zone, prices increase significantly due to excessive surge of buyers. So demand means buyers, okay? Just remember that, team. Supply means sellers in the market. In contrast, a supply zone is the price area at which strong selling interest exceed buying. In a supply zone, prices decrease significantly due to overwhelming surge of prices. So team, we're going to learn this shortly. The market participants, who are you trading with and or against in the market? Traders at any time and any given moment of trading are divided into 3 groups. You have the buyers, you have the sellers, and the undecided. So team, what are the 2 phases that we have talked about in the stock market? The two phases are sideways and directional. So there are two phases in the stock market that you need to understand. There is the sideways phase when price action is going sideways, and then there is the directional phase when prices are going either in a trend up or down. There is a permanent tug of war between buyers and sellers, and that is all reflected in the bid and ask spread for prices. Ask is what a seller asks for the stock to sell. Bid is what a buyer offers for that position. When prices go, when prices, where prices go are determined by sentiment of the buyers, sellers, and the undecided traders. The presence of undecided traders puts pressure on buyers, bulls, and sellers, bears, as the undecided contribute to the final step of the move and usually influence it to move in the direction of that breakout, which we will discuss. The actions of buyers and sellers cause prices to move up and down, and this exchange goes on forever, creating peaks and troughs through trend lines and structures. Traders willing to sell at a lower ask cause prices to drop, while traders willing to buy at higher bid lead to surging prices. So that is why a demand on the buy side will lead to surging prices, because traders are toppling each other for the best bid and ask. It all comes down to the very essence of supply and demand. Sellers are selling at a lower ask because they expect prices to fall, causing a surge of supply. Buyers bid higher because they believe prices will increase far above their bid, which is the buy, creating a surge of demand on the buy side. Your plan as a trader is to benefit from the balance of power between the buyers and the sellers and place the winning trades on the winning sides. So as we mentioned, the universal laws of supply and demand apply everywhere. All financial assets work on the universal laws of supply and demand. The universal law of demand: the higher the price of an item, the fewer the demand. Buyers do not want to buy when prices are very high. The lower the price, higher the demand. This is because buyers want to buy at a low price. But do keep in mind that in the market, you're going to see FOMO, and there are all other terms that describe when traders become very irrational. The universal law of supply. The law of supply: the higher the price of an item, the higher the supply, because sellers want to sell at a higher price. The lower the price, lower the supply, due to the fact sellers simply don't want to supply at a lower price. Supply and demand represent the huge imbalance between buy orders and sell orders at specific price range. The zones represent the movement of smart money who make up most of the market liquidity. Identifying supply and demand zones are essential for traders to know when market shifts from balanced to imbalanced states. Recognizing zones put you in the right conditions to position into the best trade setups just before they make the largest moves. So how do you do that, team? Let's take a look. Well, we are going to cover that shortly. I apologize. I want to go over all of the slides, and then we'll get to the good part. So again, buyers are demand and sellers are supply. Selling by bears pushes the market down, and this creates the term sellers are in control. So when you hear traders say that sellers are in control, they mean that the market is selling off and the market has a downtrend within the time frame that the particular investor is looking at. So if someone is going to ask me, if someone is going to be bearish, right? I would want to know what his time frame is for that bearish movement, because traders could be bearish short term and be bullish on the long term. This means that sellers are willing to accept lower and lower prices as they are afraid that they may not be able to sell high and will have to sell at an even lower price if they miss selling now. And the reason why some traders sell at loss is because of that. Like a lot of times, many positions do end up making a comeback, but traders sell because they believe that prices are going to continue to go lower, and this in turn strengthens the supply, causing more and more selling in the price decline, basically triggering a price decline. Buying by bulls pushes the market up, and this tells traders buyers are in control. This means that buyers are willing to pay higher and higher prices, bidding on top of each other, afraid that they may not be able to buy any lower. Triggered by the psychological fear that they will have to pay higher prices if they miss buying now, rush to buy, which in turn strengthens demand, which is price increasing higher. Supply and demand through candlestick charts reflect this fight in action. Price action reflects the mass psychology of all traders at any given moment. You, the trader, must think ahead, always outside of the box, distinguishing between those levels as the established zones signify smart money participation. All right, team. So there are 4 market cycles that every trader must know. Here are the 4 cycles to recognize. First, we have the accumulation. We have the accumulation cycle. So what is the accumulation cycle, team? The accumulation cycle is when we are advancing higher. So during the accumulation phase, here is what you can expect. You can expect prices to enter a consolidation and set up. We're going to cover this, but for now, I'd like us to cover all 4 cycles. So you have the accumulation, and then you have the advance cycle, and then you have the distribution, and then the decline cycle. So what do you notice about these 4 phases, team? What you are noticing about these 4 phases here is that they are all the same in terms of the 2 phases. So what are the 2 phases here? We have sideways and directional, and even this one, sideways and directional. So directional can be up or down. So what did we say, team? We said we have 2 phases to recognize in the market, right? The balance phase, which is when supply and demand dynamics are equal and in balance. And then the directional, which is when supply and demand forces are out of balance and one is overwhelming the other, triggering a market direction. So please remember this, okay, team? And where these zones, if you understand where they happen and how they happen and what phases they are, you're going to do an amazing job. So the 4 cycles are, you have the accumulation, right? The accumulation happens at the very bottom. This is when prices are, this is when buyers are refusing to make new lows, are refusing to break any structure, and they're just maintaining a very solidified consolidation inside of the zone, and buyers are showing momentum. When you see that and you're seeing bullish signals, bullish confluences with other price action strategies, then this is going to tell you that this is the right trade to take. So for instance, at the bottom of the zone, right, during this consolidation, when this was taking place, this price action strategy that showed up, which is a bullish candlestick pattern, this candle right there told investors that buyers are stepping in and that this is a nice accumulation to get a retest back to the upper resistance and eventually break it. Then you had a confirmation with this candle. So my point is, team, all of the price action based strategies that you learn on this course is going to significantly help you see this language of the market much better. I don't want you to stress. All I want you to do is take this information at a slow pace, and I promise you, with over time, you're going to get better than me. I will give it a window of 1 year that you are going to get as good as me, if not better. So team, for the first cycle, right? Again, I want to say this again. We have 4 cycles and 2 phases, all right? These 4 cycles, it's like winter, it's like winter, what is that? You know, these 4 cycles, basically. You got the 4 cycles, and that's actually a good example. I laughed at it, but that's a good example. So these 4 phases take place over and over. These 4 cycles take place over and over, but realistically, what do you have in those 4 cycles? Well, you have cold or hot. You get what I mean? It's either 4 seasons. I'm so sorry. Yeah. 4 seasons. So we got 4 seasons, and during those 4 seasons, you have 2 different weathers. You either have a cold or you have a hot. And that's how I want you guys to see price action as well. You have these 4 cycles, and you have 2 phases. The 2 phases are, one is a flat phase and one is a directional. One is a flat, one is a directional. So it can be flat, and then directional to the downside, flat, and then directional to the downside, flat, and then directional to the downside, or it can be flat, directional up, which is an advancing stage, flat, and then advancing stage. So what is going on during these cycles here that's happening? Well, what's happening is you have the balance phase, and then you have the imbalance phase. Let's go take a look at more. So actually, let's go over it. During the accumulation, price enters sideways consolidation range after cycle of decline. So accumulation happens after decline. Once this happens, team, where we get the decline, price action will then start to enter a balance range, and this will be the accumulation phase. So price enters sideways consolidation, and this happens after the decline. It is sustained base of consolidation. So during this time, during an accumulation, it is a sustained base of consolidation in a defined range of support to resistance. 3, during this time, the 200 moving average line shifts from a downwarding slope to a flattening range. So team, let's go take a look at an example of let's take a look at Google, for instance. So here is Google stock, team. And here we are in a downtrend, right? Can we say that we are in a downtrend here? Why are we in a downtrend here, team? Well, we are in a downtrend because, first of all, we're making lower highs, and clearly, in the most simplistic terms, we are below the 200 SMA line, and that signifies a bear market. So the fact that we are in this downtrend means that price is the fact that we are below the 200 SMA line signifies that we are in a bear market. So team, let's take a look at this right here. What happens during this time? What happens during this time when price action is going sideways in a range? That's right. Yes, sir. Accumulation. So we have an accumulation forming after a downtrend, and we can tell that by the bear market breakout we had from the trend, which we will study later on. We will study this price action tool later on as well. so that we can recognize these breakouts. But you can see, team, this is an accumulation zone, and you can tell this is an accumulation zone because we clearly showed demand inside, and we had been in a downtrending market for some time. So that is what an accumulation looks like. And the same way where you are seeing the 200 SMA line flatten out, let's take a look at another example. All right, team. So this time we're going to look at Microsoft. And let's take a look at Microsoft here. Same thing. We have a downtrend, right? So let me remove the downtrend so I don't confuse you guys. We're going to draw them on later on. But here we are, where price action was in a downtrend, was in a clear downtrend. And then when we started forming a zone, when we started forming that zone, which we are studying, what happened was we got above the 200 SMA line and we started consolidating above the 200 SMA line there. So price action started consolidating above the 200 SMA line there. And that's how we knew this was an accumulation zone. So when we go back to the example here, the 200 SMA line shifts from a downtrending slope to a flattening range. All right, team, that's how you know that this is an accumulation zone, because you have a downtrending slope of the 200 SMA line now turning into a flattening slope as shown. So you had a downtrend here, and then you had a flattening slope, and that told you that it is the ending stage of the accumulation. All right. All right, team, accumulation and distribution. So demand is an accumulation zone where there are a lot of buyers who want to buy an asset price for cheap, expecting price action to advance higher. Supply is a distribution zone where a lot of sellers want to sell out of their position and secure profits in expectation of price entering a decline phase. Price moves up and down in swing highs and swing lows. The swing lows are where demand occurs and attracts buying, while the swing highs attract sellers, creating a supply zone. So let's take a look at the rest of the example, because I fully went over that. What time interval is the best we need to use? Great question, Ravi, and I love that you guys are asking questions. I was hoping that our team would ask more questions. And for the second session, for our second class, I'm going to go over the supply and demand zone. So we're going to start off with the supply and demand zone from the start, and we're going to cover it again. This is just my practice so far, because I've been making a lot of mistakes, and I don't want to put that on the recording. But yeah, team, in an advanced stage, what do you have in an advanced stage? Well, you're going to see price action breakout from the accumulation zone right there. And then you're going to see price action creating an uptrend, all right? So once you see price action creating an uptrend, you should clearly see that this happening above the 200 SMA line, as shown here. And let's take a look on a live example on Microsoft. So you can see, as soon as we broke away from the accumulation zone, this is when we started trading above the 200 SMA line, and the trend advanced higher from there. So that puts us in the second cycle, which is the advanced cycle. All right. And then after the advanced cycle, we have the distribution cycle. So the distribution cycle only happens at the top of trends. Well, we will discuss that it can happen in downtrending markets too after a drop, because supply will continue to overwhelm demand. But for now, all you need to understand is that accumulation happens at the bottom, while distribution happens at the top, which is a topping process. So let's go take a look at Amazon here, for instance. Here is Amazon, and Amazon was in accumulation for several years before it finally broke down. So here is Amazon after going up for decades and decades, right? Amazon was going up for decades and decades, and Then we had a distribution forming here. So we had a distribution forming there. And you can see once the distribution was broken down, we had a market downtrend happening for 2 years straight. So actually not 2 years, we had it about a year and a half. So once the distribution was broken, we had a major downside where the price action fell below the 200 SMA line. And from there, things went downhill. And finally, just when price action got above the 200 SMA line, we broke out from the zone. Now we have an advanced stage. We have an advanced cycle. So price enters sideways consolidation range after an advanced cycle. Then a consolidation is sustained. And then the 200 SMA line average shifts from an uptrend slope to a flattening range. So this is something that you're going to see in an accumulation, in a distribution team. You see how this was rising up? The 200 SMA line, the 200 moving average was rising up. And then just as we entered distribution, you see the 200 SMA line flattening out. And then from there, once it starts to slow down, that's when things will get really, really bad. Why are we choosing the 200 EMA? Why not 50 or 20 EMA? Well, for this particular example, we are using the 200 SMA line. This is because when using the 200 SMA line, it is one of the most efficient ways of being able to identify the trend opposed to the 50 or the 20 EMA, because those can be those price action can get above, but it could be for only a short period of time before more selling occurs. So that's why we rely on the 200 SMA line more than the others. The 200-day also gives us more data. So if we were to look at the 50-day moving average, that only gives us about 50 days. Or if we were looking at, like the 50 EMA line, for instance, it only gives us, it only gives us the last 50 candles data. It doesn't provide us anything over that. But the 200 SMA line is perfect because it shows us 200 days worth of data averaged out in that simple trend. So team, what is the 200? Actually, we will discuss that later, but I'll just say it quickly too. What is the 200 SMA line simply telling us when it's trending here? It's telling us that over the last 200 days, price action was trending at price action was averaging out around 104. All right. So team, also keep in mind the way the market works, right? The way that I have learned from my experience, and this is, I will take this to the grave with me. Balanced markets are anytime price consolidates in a limited range. The phases can appear before any big economic events, policy announcement, Fed meeting, and any other big events such as consumer price index. Now, this is not always the case. However, in majority of cases, you should expect these consolidations on the bigger time frames to take place going into an event, because the way they do it is they take the market, they basically trade the market sideways, right? They will trade the market sideways like this. Let's take a look. Let's take a look at the S&P 500, for instance. All right, team. They will consolidate the market like this for months and months, right? Burning traders, burning options for whatever reason. And they could be doing it to digest the prices here from the bears when they were shorting it, because bears were still shorting, thinking that we were still in a bear market. So consolidations are very important, and yeah, they will usually happen during events, and just into the event when things have cleared up, that's when a directional trend is in place. So when you see consolidations, you should be very careful because they are also liquidity traps for the market. So for the market to keep on going, right? For the market to keep on going, one side needs to always lose, or vice versa. The buyers or the sellers have to get burned. And in this case, you can see that buyers overwhelmed bears, and they had the victory there. So in this particular consolidation, after the FOMC was released and after everything was priced in, we ended up breaking out. Prices before such data is released are analyzed by major market participants before leading up to an event. Prices are in a balanced state and prepared to trigger a major imbalance move based on released data after the event. The newly released data affects the market, creating a major imbalance as large money flow reallocate from one place to elsewhere, perhaps shifting towards safer assets. As a trader, you have to understand the psychological influence behind these events. Observe the range and understand that there is going to be an imbalance soon. Our goal is to capitalize on the large imbalance waves in either direction, as they provide the biggest market moving participants where we can profit from, where it will be easy for us to profit from. So team, you have to always also keep in mind, consolidations in a lot of times are very tricky. What market makers are going to do is they're going to do this, right? Where if this is happening on the 2-minute time frame, traders are going to trade with heavy size, right? If it's happening on a smaller time frame, traders are going to be trading with heavy size, and then all of a sudden they're going to get carried away because they thought that they were safe, but they weren't safe. So I'll show you some example. I'll show you an example here. Traders during this time, right? Traders during this time were shorting SPY. They were shorting SPY here and selling their position around here. Shorting SPY here and then expecting to sell their position back down to the support. However, eventually price action breaks out, and from there, that's it. And if a trader is stuck because they were trading inside of the zone and they decide not to cut their trade when price action has gone outside of the zone, they're making a grave mistake if they hold against that. Oh my gosh, I cannot stress this enough, team. You will be making a devastating mistake if you are, because there are two trading strategies for trading the zone, right? You can trade by buying at support and then selling at resistance, or you can trade it after you get a directional move from either side, after you get a breakout from either side. So this is why it is very, very important not to get stuck when you're trading the zone. When you're trading the zone and they get a breakout out of nowhere, whether it's a real breakout or whether it's a fake breakout, you must instantly cut and enter observation mode, because you're going to see some heavy imbalance moves in the direction of the breakout. So if you were shorting it here, if you were shorting it and price action ends up breaking out, you probably got burned really hard, because the next day it just instantly gapped up and gave you no chance to get out. So if you were trading inside of the zone right here and you got caught somehow because you weren't able to sell out work, or for some reason you traded irresponsibly, and you decided to hold longer, and price action broke out outside of the zone, you're going to you're going to be devastated and suffer heavy consequences, because when price action is trading inside of that zone, what traders do is traders subconsciously add heavy size, because the market is in a range bound consolidation and not moving up too much up or down. So because price action is in a defined range and moving very slow inside of the consolidation zone, they add size to accommodate for that. And when they add size to accommodate, that is really, really bad, because as soon as you finally have a breakout, that means the market makers succeeded at trapping him, and now they're short covering using his position, and that's what happened here. So it went from 436 all the way to 444 the very next day, team. The very next day, price action gapped up $10 once we finally had a breakout outside of the zone. When do we need to use the 5-minute versus the 15 or the 30-minute time frame? Oh, we got more questions. I am so sorry, team. Can you explain the main difference between EMA and SMA? So, Stony, EMA stands for exponential moving averages, while SMA stands for simple moving averages. The EMA happens a lot faster. So let's use an example of the 50 EMA. All right, team. So I'm gonna pull up a chart with my 50 EMA. Okay, so here is the 50 EMA line. All right, team. Here is this red line is the 50 SMA line, and this light red line is the 50 EMA line. Do you see the difference between the 50 EMA and the 50 SMA line? Let me remove this too so that you guys can just see those two. If you notice this one right here, this one, the lighter red is the 50 EMA and the darker red is the 50 SMA. If you notice, the 50 EMA is much more up to date. It's moving up because price action is going down on SPY, right? The 50 EMA is going down in a much more downsloping fashion than the 50 SMA line. In simple terms, the 50 EMA or the EMAs are faster than the SMAs. They're much more up to date than the SMAs. So let's take a look at the example fully. You can see even right here, as soon as first the 50 EMA was below the 50 SMA, right? But then instantly, as soon as you had a trend changing structure, the 50 EMA got above the 50 SMA further than the 50 SMA can move higher, even though the 50 SMA was higher than the 50 EMA. And simply put, that is because the 50 EMA is much more reactive than the 50 SMA line. And this is great for traders. This is amazing for traders. And that is why traders use the short term. So me particularly for that study that I was using, for that particular study, I not only had let's see, I not only had the 50, I also had the 20 EMA line. So the 20 EMA line is another one that I love, and it's simply it's a simple strategy. Once price action gets above the 20 EMA line, you're bullish as price action continues to trend higher. When do we need the 5-minute versus the 15-minute or the 30-minute time frame? Well, let's take a look, Ravi. You see how I identified this time frame on the 30-minute time frame here for SPY? I identified that on the 30-minute time frame, right? But then I'm going to go on the 15-minute time frame, and now on the 15-minute time frame, I can see exactly when they break out. So by entering exactly when they break out right here, I was able to catch this move really, really fast on the 15-minute time frame because I'm on the smaller time frame and I can see candlesticks more up to date. I can see candlesticks and the sentiment of candlesticks within or at that level of interest. We will discuss timeframes later on as well, team. Oops. All right, let's go back to our, okay, so we discussed what these events do and why we need to be careful. Here is what a price balance looks like, team. When price is in a balance, this is what we are expecting. We are expecting price action to be sideways. In a balanced market, we can expect price action to be flat and limited inside of a range as it digests the prior large move, also known as market balance. Neither buyers or sellers are in control during the balance range. After every balance, you'll see price action then followed by a large imbalance move. So imbalance means directional, balance means sideways. So anytime you have a balanced range where price action is consolidating the prior move, so the prior move could have been up and down, right? The prior move could have been up and down, and price action all of a sudden began to consolidate. So whenever price action breaks either side of that consolidation, that is when an imbalance move is triggered, known as a directional move. So let's draw that. This is the consolidation. Once you have a breakout, you have an imbalance move to the upside. So these are the same two phases that we discussed earlier when we started. Now, price imbalance, when the market leaves the balance range, large imbalance move is triggered in either direction. The balanced move or the sideways range is broken from. So if the sideways range broke to the downside, then we are going to anticipate imbalance or direction to continue to go towards the downside. If it breaks to the upside, then we are going to continue to advance to the upside. The large candles represent the balance to an imbalance phase in price action market. We focus on recognizing these areas of balance and place our trades just as price shifts into imbalance or directional phase. So the efficient strategy, which we will discuss, you can also trade the inside of the zone on much smaller time frames. However, the biggest profit taking move is going to come from the break of the imbalance move. So whether of the zone, so whether it's going to break up or whether it's going to break down, you're going to see a major directional move follow through in the direction of that break. All right, team. So let's now take a look at the formation of demand. So the formation of demand. Demand zones form when buyers exceed sellers at a certain base of consolidation. This happens when price drops to a zone where buyers from institutions, retail traders, and computer algorithms set at the zone create a surge of demand. Existing buy orders create a force of demand, attracting undecided traders to join forces, as potential long position here will offer extreme low risk. A breakout is confirmed when candle closes above the base range. In all demand zones, long entry is above the rectangle zone drawn on your chart. So long entry is triggered right over here, which we will look at live examples soon. So team, this demand zone right here, this one could be, this one could have been like that. I'll show you, okay? This trend could have been completely down, where the market was going down in a downtrend. This could have been like that, right? This could have been absolutely downtrending, or it could be like this. It could be coming up and then consolidating. Either way, that does not matter to us, right? What really matters to us is where the zone is broken from. Wherever the zone is broken from is going to trigger major imbalance to the upside. So how do we know that a certain level is a demand zone? Well, the way you're going to be able to tell is the size of the candles that appear inside of the zone, the size of the candlesticks, the anatomy of the candlesticks, and the dynamics within the zone visually. You can see it visually too, and I will show you, team. Let's take a look at some zones, all right? So here's SPY here. And here are some zones to trade, for instance. this zone in particular, and team, keep in mind, zones are always going to have, not always, but zones are also going to have these fake outs where you're going to see a huge fake out operation. However, as long as, if you see something like that, right, even if this candle's red, as long as they close the following candle inside of the zone, then it will push higher. Oh, we're looking at Apple today. Let's take a look at Apple, team. We're going to apply this zone on Apple, and we're going to trade Apple. All right, team. So here's Apple on the 15-minute time frame, right? What I'm going to do for Apple, the first 15 minutes of Apple, when market opened, Apple did a huge move, just making a huge up and down move. So inside of that up and down, I'm going to draw my supply zone. Sorry, I'm going to draw my zone. Now keep in mind, team, since this is going to be more of my stop and not my actual support zone. So when you're drawing a zone, right? Let me delete everything here. When you're drawing a zone, you want to connect more than one data point. So you see how you see how we have these data points here, these candles here. We have these candles that are clearly in the same, like, they're bouncing at the same levels. They have the same bottoming lows. Well, I'm going to draw a rectangle, right? And to draw a rectangle, team, don't worry, Tuesday session is going to be much better, and we're going to cover all of these materials. So this session right here, this first live class session, is all complimentary on me. So yeah, team, four zones, you're going to catch the most data points you can get. So you're going to catch these 2 data points there, and you're going to catch the 2 data points on top, and then you're going to extend your zone to the right. So to draw this, you're going to go to your chart, and whatever platform you're using, you're going to have this option where you can draw a rectangle box. So that's how we're going to draw our supply and demand zones. It is the most easy concept for you to draw. Very, very simple. All you have to do is just create that consolidation zone and connect 2 data points on each of the sides. After any time that you have a major imbalance to the downside, such as this, where price action goes from 194 all the way to 188, what you're going to see is you're going to see a zone formation. And if momentum is showing strength to the upside inside of that zone. So for this particular trade, what do we have here, team? Well, we have a massive imbalance move, right? And then we have a zone, and then we have a massive rally back up. So those 3 candlesticks, what they create is what is known as a morning star candlestick pattern. So this is what a morning star candlestick pattern is. And you can see this is about the same as that one. This can be longer, this can be green, whatever the size, it does not matter. All that matters is that red being taken out by that green. And once you see that, that is your clear confirmation, or not clear confirmation, I apologize. That is your that's basically a great sign for you to be confident to take that trade. That can be your entry. And then your confirmation is going to be the break of the zone at 190.48. So for today's session on Apple, right? If you were watching Apple like I was, not trading at the market open because it was too unpredictable after the massive gap down, you could have waited 15, 30, 45. You could have waited about an hour. Within the first hour, you had a clear defined zone. You had this one. Let me show you. I'm going to delete the zone, and I'll do it again. You had these 2 levels here, okay, team? So you had these 2 levels here. You had these 2 levels there. And then you had these levels here down here. So not only did you have these 2 touching, but you also have these ones touching in the near future. But within the first hour, you saw these 2 levels being created as well as these 2. So you had 2 tests at the bottom and 2 tests at the top of the zone in that particular first hour on Apple. And then what happened after the first hour? Well, 2 hours later, after us buying the dip down here, right? Price action then finally comes back up to 190, which is the resistance of the zone, and then triggers a breakout above the resistance, which we anticipated during the live session. So this trade was a great trade if you simply took it by buying. And I did see some of our members taking this trade. But yeah, if you took that trade, this was an incredible trade. And it was a very, very, very confident one too, because you had a clear zone breakout. So once you see this happening, right, where you see a massive supply candle being taken out by two demand candles there, this is a clear on signal that bulls are going to continue to push higher and overwhelm supply at that level. And then, team, when you use other price action based tools such as retesting the 200 SMA line and so forth, filling the gap strategy, that becomes better and better to trade with time. That's good to hear, Florida. That's really good to hear. My oh my, you said, should we be using the EMA or the SMA? For the longer term time frames, you can use the 200 SMA line. For the shorter term time frames, you can use the 20 EMA line. Does that help? So team, just because you had a breakout here, right, does not mean that you're going to keep that zone there. You can delete that zone because you already got the trade in, right? And then if you see this forming here, if you see these three candles here forming, what I'm going to do is I'm going to connect these three candles with, you know, with these, whatever, like this candle here connects with this one. So if I can get candles to connect like that, where, you know, they're like that, then you basically have a defined zone and you can trade the zone. Now, keep in mind, team, you can also do this, right? You can take it all the way up here and you can do this, and that would be as great. But the reason why we don't do that is because we would already know that price action is going there, right? So our job is to recognize that there is weakness. So here's what I mean. If I include just these two candles, right? And if there was a weak candle here, that would have told me this is really weak and I need to just get out. However, there was no weakness there. We saw a massive bullish engulfing, and that is why I believe this resistance was also going to break, and that is what we have here. But yeah, team, there is no right or wrong way of trading this. Keep in mind, I'm doing that on the 15-minute time frame, but we can do it on the bigger time frame. So this one in particular, this zone, we can recognize it on the 4-hour chart, and then let's draw it, right? So if I draw the zone, and then I go back to the 15-minute time frame, you can see I can trade the support. I can trade the support of this zone, and I can also trade the resistance of it. However, right over here, when you had a clear breakout candle and price action clearly maintained above the 200 SMA line, you can tell this was an accumulation zone for price action to advance higher. And that's what we are seeing here on the 15-minute time frame. So what I want the team to do going into tomorrow's trading session, I want you to draw zones on the weekly chart and on the daily chart, because what I'm going to do, that's going to be your homework. What I'm going to do tomorrow morning is, sorry, not tomorrow morning, during tomorrow's open market hours, or even after hours, we're going to basically we're going to study those zones that you drew. We're going to look at them, and we will help you correct it if you are doing it wrong. So yes, sir. For any ticker, it does not matter, my oh my. Find me good zones. Find me good zones. How much time do we have? We have 30 minutes for this session. So I'm going to show you guys how and what kind of zones to look out for. and you find me zones that are within that category. So team, when identifying zones, right? When identifying zones, you can't just identify a zone. You can't just identify a zone when I'll show you an example. Like you can't just identify a zone right here. You see this zone here when price action is already consolidating, like you can't identify a zone here because there is no major imbalance here. You know what I mean? Like there's no direction. So anytime you see a consolidation zone, it should be digesting a massive prior move. All right. It has to be digesting a massive prior move. So if I'm going to draw that zone, instead of drawing it just on that small candle, I'm not going to. Well, I can do that. I can do that here, you know, and it still works. But what I would prefer the team to do, I would prefer the team to do it after major imbalance moves. So we have discussed this outside of this course as well. When you get and we will discuss it again, team. When you get a massive imbalance move to the downside, if I would ask you, if I would ask our traders here, now you guys would know how support and resistance levels are created. But for those of you that don't know, support and resistance levels are created from major imbalance and major demand and major supply imbalances. So resistance was formed here because we had a major imbalance, and you can see this was still major resistance there. And that's what you want to look for. You don't want to look for zones just right here. You don't want to mark the zone, okay, team? You do not want to mark the zone by itself. You can just to see the trend breaking down. However, I want you to draw these zones and trade these zones after major moves, major downside moves like this, and then you see price action consolidating like that. All right, team? And once you've seen price action consolidate, all you really need to do is just draw a box. And once you draw a box, draw two levels here so you can see the support and resistance levels with their price. And I'm going to move that, and you can see how well that plays out, team. That's what I mean. So the whole point of you recognizing the breakout of the zone is to catch a imbalance move in that very same direction it came from. It can happen like that. Or if this was downtrending, right? If this was downtrending and you got below 124.71 74, then you are going to short this to the downside because you would anticipate the directional move to trigger to the downside since the break happened to the downside. However, in this particular case, the break happened to the upside, and price action clearly held right here, telling investors that this is a clear breakout above the zone. Any questions so far on zones, team? Oh, wow. It instantly let me. I love it. Yes, exactly like that. Exactly like that. What time frame is that? That's the weekly chart. Oh my freaking God, man. That is caught on the weekly chart. How amazing is that? That's really amazing. That's really amazing. Look at that massive breakout it had too. That was good. So yeah, just like that, team. Once you catch it on the weekly time frame, what I want you to do now, I want you to go on the 1 day on the daily chart, and I want you to now trade it on the daily chart. I want you to trade to trade that zone on the daily chart for the future. So team, do you understand what I mean by drawing zones after directional moves have taken place? Is everyone on the same page on how to draw zones? Please, if you don't understand, you got to ask because you paid for this. I want to teach you. Everyone in here is going to wait for you to learn this. I love that she has that too. Amazing, by the way. Amazing. I love that. I wonder if that is an algo or she does it herself. I'm pretty sure that's an algo. Team, does everyone understand supply and how to draw zones? Does everyone understand how to draw zones? Or does anyone have any questions about what I mean by drawing a zone after a major directional move? Perfect. Love it. Love it. So, I will explain it one more time. Also, I have a question about what you mean by trading the daily, or did you mean intraday in the zone? No, since that was a weekly chart, right? Because that was a weekly chart where each candle represents 1 week. If you draw your zone on the bigger time frame, what I want you to do is I want you to go to the short term time frame, not the shorter term, short term, but I want you to go down within those time frames. So if you got something on the weekly time frame, I want you to go to the daily chart and the 4-hour chart so that you can trade that movement on the 4-hour chart when they approach those levels. Also, one more thing, my oh my, once you're inside of the zone, especially when the zones are much wider, right? Team, I wanna say this one more time. Keep in mind, please, when you draw zones, zones are very, very simple. And when you draw them, you want to draw them on after a directional move, whether up or down. You want to have an advance or a decline cycle before you draw the zone. Okay. The whole point of the zone is to show us that the market moves in 2 cycles, right? What are the cycles that the market moves in? Directional or sideways. And the directional can be up or down. So in this case, in this particular case, the directional move is going up. And based on our supply and demand zone formulas that we will cover tomorrow, if we look at our supply and demand zone formulas, you can see when you have a rally and then you have a base formation taking place, you're going to see another rally because there are 4 types of supply and demand formulas, and that is one of them. So that is one of the continuation zones, and that is what triggers this major imbalance move to the upside, team. All right. So the reason why I drew that zone there, the reason why I drew the zone here is because here's what I have. I have one day, I have this previous breakout, right? And then I have these 3 data points. And even if I don't include those 3 data points and I include something like that, that's still perfectly fine. But the reason why I'm including this data point is because this is a retest of this breakout. So I'm going to include the low of the data points there, so I can connect 1, 2, 3. I can connect 3 candles there, and on the top I can connect a whole bunch of candles there just by putting it right there. So then after I draw my rectangle, I'm also going to draw a support and resistance level just so I can see the numbers very, very clearly. So this particular chart I'm finding on the daily chart, right? I found this setup on the daily chart, and then I'm going to go on the hourly chart so I can trade it. But before I do so, I want to teach you something about zones. When you have zones, right? What will happen is if you have a rally-based rally potential, for the rally-based rally, you're only going to, you may see 1 or 2 tests at the bottom of the zone before you see the final breakout. You may see 2 tests at the bottom, but you may see 3 tests at the top. All right, team? So you can see right here, we only had about 1-2 tests here, barely 2 tests, but that's not what matters, okay? What really matters when you have a rally and then you have a base formation, especially when there's a bull market in play with price action trading above the 200 SMA line, when you have that, your main goal is not to short it to the downside, but to go long when you get a breakout. Does that make sense, team? Why does this why do we do that? The reason why we do that is because of this supply and demand formula. The supply and demand formula shows us that when we have a rally and then we have a zone, a base formation, the bullish characteristics are it's going to follow up with another rally. And that is what we have here. We have another rally. So that is why the most important part is the way they break out. So for the breakout, you can see they are very, very clear about the breakout. They had a clean breakout candle. And even when they back tested it, they had a very clean back test at the breakout. And that was all the reasons for you to be bullish on the setup long term. Yeah, team, that's what we saw. So let me go ahead and remove these. Let me go ahead and remove the zone. Oh, you know what? Before I remove it, let's go to the 15-minute time frame, okay, team? And let's take a look at it on the 15-minute time frame. So here is the 15-minute time frame. And let's say that you are watching the zone on the 15-minute time frame during the market hours or into the next day session. You can see this one happened right at the opening session. Within the first 15-minute time frame, right? Within the first 15-minute candle that appeared, what we had was a massive bullish engulfing candle that closed above the breakout of the zone. It closed above the resistance of the zone. So this was a clear signal that buyers are now ready to trigger the next imbalance move to the upside, as shown from 174 all the way up to 185. So that is what we mean by trading the zones. This particular zone, team, take a look. You can see when we break out, and we have talked about this too, like you will get an early breakout on zones. You will get an early breakout, and then what will happen is you're going to get a back test at the zone, or you may even get some back, some sell-off back down, like 20% back down inside of the zone. However, what is the most important factor is seeing a major bullish engulfing, some sort of bullish hammer happening just at the reversal of the breakout there. So the breakout needs to have the proper candle getting back up above the zone, which will reset the breakout. So take a look at the zone here, team. You can see anytime price action tested it, it had a clear on rejection. Look at it. It had a clear on rejection. You can tell this was a rejection. But then finally, you get a breakout. And guess what? Once you get a breakout, you can clearly see that they are holding. And anytime you get a breakout and you're confused and not knowing when to go long, you can go long above whatever the next whatever the most recent structure was, and in this case it was 156.73. So once they got above that, nothing but rocket mode from there. So can we use the 4-hour or daily time frame to draw zones? Yes, 1,000%. 1,000%. That's what you must do. So I wouldn't recommend our traders drawing zones on the 10-minute or the 15-minute time frame and then going ahead and covering the zone, and then going ahead and trading the zone on the bigger time frames. That is a terrible idea. What we want to do is we want to define zones on the bigger time frames. It's just so much easier to define zones on the bigger time frames, team. Let's take a look at NVIDIA. Well, NVIDIA has been a bit wild, but even NVIDIA, let's take a look at NVIDIA here, right? So I mean, you can see it right there, team. Like even that zone right there, you can see once they got below, they just went down, and that's happening on the 15-minute time frame. And if I show you this zone right there, if I show you that zone with our formula, you wouldn't be able to tell the difference. They're literally the same things, team. The same things here. Same formulas over and over and over. Once price action shows weakness closing below it and the following candle does not get back inside of the zone, that is major bear signal for a major sell-off to come. So yeah, team, you're going to use the 4-hour chart, you're going to use the daily chart, and you're going to use the weekly chart so you can find these zones to trade, all right? And once you find the zone on the weekly chart, you're going to, so first I'm going to draw this, I'm going to delete this, okay? I'm going to delete this and I'm going to draw the zone here on, I'm going to draw the zone here on NVIDIA. I'm going to draw my line. And then I'm going to go to the 1 hour, the daily time frame. Okay. So I found that on the weekly time frame, right, team? But then I'm going to go in the daily time frame and look at how clear it tells me once they broke out. Once they broke out, all of these candles tell me that they can push higher. And team, as soon as they break out, be confident that they're going to advance higher. Even if it kind of seems like they're faking out a little bit, they're going to continue to push higher. And that's why having long-term positions is so important, because as long as you have long-term positions, it's just going to continue to grind higher. Yeah, so something I wanted to share here. Here's another zone, team. Here's another zone on Tesla. So Tesla went from 151 to 192, and then from 192 came back down to 178, established support at 178, and then came back down to 192 and then broke out. So I'm going to go to the hourly time frame and I'm going to take a look at that zone on the hourly time frame to show me when that breakout happened. So here's the hourly time frame, and if I zoom in on this time frame, you can see once they broke out, the breakout happened during the market hours. So as soon as that candle appeared right there, you could have entered way ahead of time in expectation of the breakout taking place. And even if you entered right here at 193, by the time it went to 198.35, you absolutely banked, team. Those three candles that happened after traders came back up near the zone and showed clear demand candles that looked like they will be able to take out the zone, you know what happened? Price action went from not even here. I'm not even going to count here. I'm going to count the breakout entry. Okay. Let's say you entered, so the market opened at 6:30, and then another candle went up, and then in the third hour, right? In the third hour, what we have, sorry, in the second hour. So this was the first hour, the second hour, and this is no, this is pre-market. This is the second, and this is the does that even matter? My point is, team, by 8:30, 2 hours after the market opened, right? After the market opened, 2 hours later, I didn't have to buy on this crap. I didn't have to buy when momentum was weak. I could have entered right here as soon as the zone broke out with a very beautiful candle, and I would have gone from 193. Even if I entered here super late, I would have gone from 193 to 198 just before the closing session, and I would have banked on that trade. And that's just by identifying the zone on the daily chart and then going to the hourly time frame to trade it. And same thing, like as soon as you saw that gap being filled, you could have drawn another zone on top of that. So I could have drawn another zone right there, so I can further tell when the breakout would happen. And this candle was a clear breakout. So I could have entered on this candle with my stop loss down here, and I would have profited from this whole move. So I would have profited from 202 all the way up to 209 in just a day and a half. Does that help, team? Does anyone have any questions so far? Also, for those of you that are in here, I'm probably I'm going to stay for an additional 2 hours, an hour, maybe 2 hours. We're going to cover everything about zones because I don't like that. I felt this sort of pressure on me and I didn't explain it really well. So now that the class time will be over in 9 minutes, we're going to cover it even more. Also, I want to mention again, team, this session is not the official live class for the course. This is just practice. Our first class will be on Tuesday, which I will send out a message for. This one is practice for me, and I thank you all for joining. But yeah, let's take an 8-minute break. How to identify? Oh, I love it. Good questions are coming. How to identify false breakout if it tries to reverse back up? I cannot wait to cover this. Let's take a 8-minute break, team. 8-minute break. TOS script. Yes, sir. I got you, Curtis. I'm gonna post it right here. I'm going to post the script right here. I want us to take an 8-minute break and then come back, get your popcorn, and I'm going to talk for another 2 hours. And I want to cover as much details as I can on zones so that our members who put their time to be here are going to have their times worth something to learn and take into tomorrow's trading session. Team, I really hope, I'm gonna say everyone's name in here. I want you guys to study this, okay? I want you guys to study this, all right? Please. The zones we are practicing, I want you to study it. You have, team, I just want to say this, okay? Ever since I have learned this stuff, I can't even remember, like I can't even remember the last time I got burnt on puts or I got burnt on a wrong trade. Like, yes, trades will happen against me because maybe news will affect me, but we will rarely have positions going against us with the information that we have. And the fact that you guys are going to be learning this stuff and you guys are going to bring it to my awareness because you're learning this stuff, oh my God, man, this is going to be a game changer for us. I think our probabilities are going to skyrocket higher. I love it, Chuckles. I freaking love it, man. I so much love it because once you learn this more and more and more, and you learn all of the little details about it, oh my gosh, man, you're going to carry that with you for the rest of your life in any market. The economy's crashing. Who cares? Who cares if the economy's crashing? You have a defined strategy, core strategy to test. Team, I just want to show you something. All right. I'm going to show you something. I'm going to show you the $50,000 course. All right. The $50,000 course here. I'm going to show you. Okay. Give me one moment. So I have access to this $50,000 course. And the way we have our course is going to be the same thing. So, sorry. I'm so sorry. The way that we have our new website is going to be in the same way, just a little bit less complicated. So you guys, here is the $50,000 course. This is the $50,000 course. And if I click on core strategy, right? If I click on core strategy and I go to recordings, it's literally the same things that's us. So the way that you guys are going to have access to all of this information, you see how I clicked on core strategy here? So if I go back, this is a $50,000 course. Can you believe this course costs $50,000, team? Can you believe this costs $50,000? I'm not bullshitting you. This costs $50,000. $50,000, and I am showing you the information for 250. Believe it or not. And believe it or not, you're going to learn everything that's on there because we are just scratching the surface of it right now, the surface of supply and demand zones. But that's all you literally need to know. So team, let's take a look, okay? the way our website is going to be, it's the same way. You're going to click on my courses, and it's going to take you to all of these options that you can. So this is going to be course strategy, supply and demand zones, candlesticks, and each of them that you click on, you're going to see these live sessions, these recording sessions that we are teaching, and it's going to be session 1, session 2, session 3 that you can watch over and over and over. So let's say I click on session 1, right? This is what's going to show up. So if I click on session 1, this is the things that they are teaching here. And team, you see the comments. I want our team to participate. It makes me very sad seeing my team not participate when all of these people participate on the other groups. Like, do we need to raise the prices for others to see the value in us? Obviously, I'm a terrible explainer. I still need work, but it would really help and encourage me if our team participates. You can see, like, how do you determine what trade, everything, like all, they share stuff, and that's what we want, team. I want our team, and our team will be able to see these comments too. So I'm really, really hoping that our team is going to ask questions and utilize this as much as they can. So team, let's just go over the course strategy, right? Look at what they, oh my God, look what they're teaching. Look what they're teaching, team. Look what they're teaching. What is this? What is this right here that they're teaching? Team, what are they teaching here? Please tell me if this is not in our language here. This is what's worth 50,000. This right here is what's worth 50,000, team. Exactly. Zones, man. And I know these zones by heart, man. Like, I know these zones better than I know my entire city. And I did Uber for many, many years, man. Like, I know every corners of my city, and yet I know zones better. I never in my entire life would have thought that something that I was the weakest at would be my strongest. And this is literally what they are. Look what they are teaching you. This is a zone. This is a zone. And what happens? They break down once the zones happen. And guess what? We have, you already know. Matter of fact, you know what? Let's pull up something, team. All right, give me a moment, because I want to encourage you that we are on the right track. It's just I need time to teach all of this stuff, and this is our first day. So this being our first day, oh my God, we're gonna have such amazing times. What I want to show you, team, what I want to show you is where is it? Where is it? Complete guide to supply and demand zones. All right. So here is complete guide to supply and demand zones. And team. What is let's take a look. Do I fix that? Because I should fix that. Where's our chart? Where's our chart now? I mean, where's the 50? Okay, you see this, right? You see this retest here that they short, this retest. I can already tell what they're teaching here, team. This stuff that they're teaching, you know what they're teaching here? This is going to lead to downside. And let's take a look. Who's buying here? All right, let's see who's buying here. Nope, it's going to get shorted. What happened? And team, I swear someday, oh, look. You didn't see it, right? You didn't see it, but what happened, team? What happened there? You saw how we came back, we pulled back, right? We had a major pullback from there because it retested a supply zone, which is where retail has their buy orders. And now look, let's go back to the one that I taught on YouTube, and it's literally a retest of that zone right there. You see, why was this a perfect short? Let's see. You see that? The previous, you see that, team? That's a video on YouTube that you can watch. my point is, the point that I'm trying to make is, I have already covered these materials, like all the things that they're talking about, how this is a previous supply and how we're going to get a rejection there. I'm telling you, what I'm teaching you is the surface, man. I'm teaching you just the surface of it right now. We haven't even gone to the hard part, team. Holy crap. Like, sorry, not the hard part. I mean, the good part. So I am telling you, this is what they are teaching traders, and that's what we are going to learn, team. Candle components. Look at that. They're literally teaching you candlesticks. Like, we and all of this stuff too. Like, oh my gosh, I'm so excited. I cannot wait to teach the team all of this stuff. So the reason why I wanted to show you those $50,000 course is to keep you encouraged that I am teaching you something that is worth $50,000. And you can either take it with a grain of salt, or you can actually pay attention, follow what I'm telling you, and take action. And if you do, oh my gosh, man, oh my gosh, I can't even. All right. So yeah, team, what I want to do now, I want to take an 8-minute break here from 7:32 my time here, 7:32. I got to fix the time. I'm always anyways, team, there we go. It is 7:30 right now, 7:34. We're going to come back at 7:44, okay? So at 7:44 we are going to come back. Wait a minute, 8. Oh, okay. Yeah, we definitely have time. So it looks like I had an extra hour on this live session. So we're going to get off at 8:30 my time, which is an hour from now. So we're going to take a 8-minute break, and then we will be back in 8 minutes covering more of the zones. When I come back, I'm hoping our team has more questions. If not, I no problem. I'll cover some things. So yeah, team, break time. If I'm drawing a zone at first, it may not have a high established. Can I just extend it when a new high or low is created? Exactly, Lola. Exactly. That's the plan. Oh, I like that. What time that's Amazon today. Yes. Okay. Versus swing trading start. Yes, that is right, Stony. Yes. Especially if you're someone that doesn't have a lot of time to spend on your disc. Here's what I say, okay, Stony? I say ignore all of the other crap. And just focus on trading the zones. Like support, resistance levels, all that stuff, remove them and just trade off of the support and supply and demand zones, and start off, and then slowly incorporate everything else. So what I want our team to do, right? For those of you that have been trading price action, or especially if you are new, ignore everything else and just do the zones. Just simply do the zones. So this zone right here, this is great on Amazon. This looks like the daily chart. So let's go ahead and take a look at Amazon there. All right, so Amazon on the daily chart. When was that? Oh, is that right now, or? So that's the daily chart. What time frame is that? Oh yeah, that does look like today. Okay, so we're gonna draw this zone here. There we go. Now, your question was, if I am drawing a zone at first, if may not have a high established, can I just extend it when a high or a low is created? Yes, exactly. So that's what you're going to. Matter of fact, oh, great question. I see what she means, you guys. What she means is, like, if there's no low established here, right? If there's no low established, can I extend my zone when it has been established? Like, can I extend my zone like this to this when it has been established? The question is yes, 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 1,000% yes. Now, Amazon itself is very tricky. Now, keep in mind, we don't have to always draw zones on things, uh, like, I mean, on price action that doesn't have it. But I promise you, if something looks like it is zoning, it is consolidating, like this one in particular, this example here. You see, we have three clean tests, right? And I'm going to extend it just to cover these two candles. And if I extend it to the future right there, so I can catch all the futures, let's put the levels on it, and then let's go look at it on the shorter term time frame. That's what you want, team. Obviously, you want to find A quality zones, okay? You want to find A quality zones. So for that chart, I drew it on the daily chart, right? I drew it on the daily chart, but then here's how it looks on the 15-minute time frame. Here's how it looks. You can see once bulls had a clear hold at support, the next day had some major imbalance moves to the upside, and from there it just was nothing but breakout from their team. So once you get a breakout above the zone, that's what's the most important. If you're in a bull uptrend, right? If you're in a bull market, your main focus is to catch this replica here. This replica right here, that's what you're trying to catch, okay? So when this consolidation takes place here, when that digestion takes place, you should be prepared for a breakout, so that as soon as there is a breakout, this is what you are expecting. So team, remember, you want to go with the trend, okay? And one of the best ways to go with the trend is by trading the breakout of zones. And the way you trade the breakout of zones is just so like, as soon as they break the structure, you see that the momentum is clearly there to break the structure. They're going to break out. They're going to break out with time. And from there, all you really need is a defined stop. So if you're going to enter there, your stop loss is going to be 115, and your profit target will be anywhere from there. So how much are you losing for that? Well, you're giving up $3 to catch even 118 to like 127. That was amazing. Like when you had that reversal, or even before the reversal, if anyone had even got out right there, even that itself is far worth the risks. Because if you're entering above the confirmation there at above the wick, so first the breakout of the zone is your confirmation, and a lot of time the breakout of the zone is your entry signal. And then a lot of times you're gonna see wicks, right? You're gonna see these little wicks. Sometimes they're gonna be longer. The point of the wicks is the function is to trade them as confirmation. So you're using them as confirmation. So as soon as bulls get above 118.61, I'm going to draw that line just so that we can see how crazy they react once they go above 118.61. So let's go look at it on the smaller time frame. Look at it on the 15-minute time frame, and you can see, like, I mean, this itself, as soon as they broke out, that was very clear. They just kept going. They broke out hard. But yeah, team, there was multiple confirmations. Like if you use a resistance level, you can draw this, right? And you can be like, oh, they broke that resistance on the hourly. So that is why, it's going to trigger a breakout. You can see that was an hourly breakout. And then you had the massive imbalance moves to the upside. Now Rainbond and I use the same strategy because I mentored Rainbond. However, Roger Roger has his own strategies. Roger uses his own strategies. Um, and yeah, um, so team, how do we catch fake outs, right? Let's take a look at some fake outs. All right. We're going to take a look at some fake outs. Let's go to, um, let's go to Apple here on the 4-hour time frame, and let's define some zones. So this zone right here, no, this doesn't look like a fake out. Okay, this is one kind of a fake out. This is one kind of a fake out. I'm trying to decide whether we're gonna put our zones to cover the drop, or whether we're just going to cover the main supports of it right here, which was the, you know, where the main data points were. But team, I just want to say this, okay? The top side, okay, I'm going to show you this, okay? I'm going to show you this supply and demand zone right here, okay? And I'm going to ask you which of these, the support or the resistance, is more defined here. Which side is more defined in terms of data points? That is correct, team. And let me show you why. Let me show you why the resistance side is more defined, and why this is an amazing thing. If 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 um if we are in an uptrend, all we care about, if we are in an uptrend, all we care about is whether they're gonna go back up, because that's all we care about. As soon as they go back up, what we are going to be watching is a breakout above a key level resistance, which is the top of the zone, so that they can trigger that imbalance move. That's all we care about, them having that breakout. So if we are going to see something like that, where like Apple in particular, where we are not seeing too much of a support being formed, and that's not on us. That means that if not too much support is being formed, that's perfectly fine for me. Guess what? Guess why it's perfectly fine, team? I know what's going on the trend. I know this is an inverse head and shoulders. So I don't always have to depend on a perfect line of especially when it's so unnecessary, because the reason why the support there is unnecessary is because of this, team. Let me show you. When price action is in an uptrending structure, you have two types of continuation zones and two types of reversal zones for supply and demand formulas. So that is see, I love that we did this course, because now you're seeing exactly, you're seeing the 200 SMA line, you're seeing price actions above the 200 SMA line, and you know this is a bull trend, you know this is an uptrend, and you know that the zone, once it breaks out to the upside, is going to trigger major upside operation. So this that you're seeing, this zone right here, team, let me draw the zone. This zone that you're seeing here is simply this formula here. It's formula number one for supply and demand zones. It's this one right here. You have a rally, you have a base formation, and then you have another rally back up as soon as you have a clear-cut breakout right over here. So once you get a clear-cut breakout like that, this is a clear on breakout operation, and that they're going to go higher, especially when you have an inverse head and shoulders like that, which is another price action based strategy that you can also find in the course in page. By the way, team, for the next Tuesday session, I will encourage our team to have the course open, so that they can refer to the examples that we're looking at. So for the particular inverse head and shoulders, this is an inverse head and shoulder, team. You can find it on page 256. Actually, it starts on page 254. So this is an inverse head and shoulders, and you can see like once you get a breakout, that's it. And this time you have a breakout, right? You have a early fake out and then followed by a pullback right up to the basically turning what was resistance into support. Team, this process is very important, okay? This process is healthy and very important. So to answer your question, just one of the ways, we are going to cover many other ways. One of the ways that you can recognize early fake outs on these zones is or to not fall for the fake outs is to see something like that. When there are ways, sorry about that. There are ways where sometimes you're going to see it pull back halfway, right? Sometimes it'll pull back halfway, and then sometimes it will pull back and bounce exactly at that, turning it into support. Now, when it falls back down here, that is terrible. That is very terrible. And we want to be instantly out of the position as soon as they come back down here. However, if they come back down, let's say you already cut your stop loss, right? And then inside of that, inside of the zone, they printed a massive green candle like that all the way back up, right? Let's say they printed a massive green candle like that all the way back up. If they did that, regaining the zone, then you have a clear signal to re-enter that trade and be even more bullish than before, because that is a starting trend of major upside to come. That's how they do it. Like you're gonna see them, and we'll look at some examples too. But team, this particular one here where they retest the support of the breakout is known as a back test. So let's take a look at some examples within the course on inverse head and shoulders that back test their looks like we may not have it, but okay, this is more, yeah, see, this is a breakout retest strong buy signal. So you're going to see a breakout first, you're going to see a little run up, and then you will see a pullback down, retesting the support of the zone, which is known as a back test of the breakout. And that is a clean bullish signal that they pick up the buying the buying orders there, and trigger this move up like that. So um team, what I'm trying to say is, when you have an uptrend, the support, how well they establish the support does not matter, because if momentum is too strong, they're just going to reset it once and push it back up. And what if they have an inverse head and shoulders? Then that means that you're going to have to adjust your zone to really turn it into your bias. However, what you really can do instead is you just have to know, if we are in an uptrend, then the priority is to catch the uptrend. It's not to short it, it's to catch the uptrend. I'm not saying you can't short it, but I'm saying the priority is to catch the uptrend, because that's where the higher probability comes in from. And that's what you can see. Like once you get a breakout, you get a similar range that we saw here to here. Should we be using the same basic zone setup strategy for day trading versus swing trading? Start with 4-hour daily, weekly to draw the zones and then focus on the hourly. I absolutely love it. Stony, if you do that, you're going to turn into, oh my God, you're going to turn into a beast. If you do that, I promise you, you're going to become a great trader. You know why, Stony? Because I myself have started doing that, and holy crap. And being above would provide additional confirmation. Yes, sir. Do we need 2 or 3 touches at supply resistance for confirmation? Yes, Tony. So let me show you something, okay? You never for the upside, right? Especially for the upside. Now, what did I tell us? What did I tell us earlier? I said for the support, that's okay. If we are in an uptrend, the input is if we are in an uptrend, the support of it being tested once or twice, that's fine. All right, that's fine. However, the resistance has to be well established. The resistance has to get at least 3 tests in it. Sorry, at least 2 prior tests in it. So you will never ever go long on something that just gets a test and then the second one. That, yes, sure, but it's super risky. I'm telling you, it's super risky. You want to see multiple tests because that is what provides the high probability trade. And team, while being inside of the zones, like if you're inside of a zone, right? You can even have 2 of them. You can have a line there, and then you can have something that covers this one, that covers all of this, like as much as data points, right? Within the candles. And then if you do that, like you can even buy, like if you see if you see Apple placing something like that, and then you see a massive bullish engulfing and then a consolidation, you can buy ahead of time before you get the breakout. So if you buy here, even if you bought on this bullish hammer, right? Like you saw like all of this screams bullish. All of these candles here scream bullish after a candle like that, because it tells us that they're eating liquidity on both sides, absorbing liquidity on both sides, and they're simply closing the session exactly. Look at this team. You see the high of that institutional candle? They defended it 3 candles out of those 4 that they consolidated. If I count this one, 5 candles out of the 4 that they consolidated. They closed above that candle, which means that's how bullish it was. But once you get a bullish hammer, and then you can enter at the breakout of the following follow through candle at the high, at the breaking high of the bullish hammer. And if you would have done that, you could have, even if you entered, let's say you entered on top of 4 candles, just to be very, very certain. Even if you entered at 152, you could have, even in the early fake breakout, it went from 152 all the way to 162. So even the fake breakout gave you an enough move to be very profitable, and that is the beauty of being on the right side of the trend, man. Like once you learn this stuff, it puts you on the right side of the trend. Like, look, I'm gonna draw it again, right? I'm gonna show you another strategy. Whenever you have a breakout, anytime that you get a breakout above a key level resistance, you see how this was a resistance? Anytime you have a key level breakout, draw a line, draw a resistance line, and go long as soon as bulls get back above it. I'm going to draw another one, okay? I'm going to connect this data point and this data point together, and I'm going to draw a line. And then what do you see? You see once they break the resistance, another trigger. Why? Because you're going to learn the structure. You're going to learn. Actually, I'll show you right now, since we are free forming. The course is over for now. What are we looking at? All right, so support and resistance levels, that's where it's going to be. So it's something like this, team. It's something like this, all right? It's something like this, where the previous level turns into support. Rainbond had some great examples, but I think they may have been scraped out from the course. But she had some very, very great examples of these levels turning into support, where resistance would turn into support. It may still be in there. Oh, yeah, it's still in there. Oh, my God. See this? By the way, this Rainbond made them. And look at this, team. Uptrend market structure of support and resistance. Just look at this, man. It's the same replica, and it's not even, it's from different times. It's like years apart, but same thing. You see it? This was resistance here, turns into support, another move up. Then that resistance turns into support, another move up. And then, sometimes you'll see back tests. So that's the beauty. Do we charge zones in pre-market or post-market? I would like to see an example, because I actually have my I have my zones off. Sorry, I have my extended market hours off, so I can't see them on my chart. And ever since I did that, I swear to God, I have never been so clear in my life. So if anyone is interested on how to do that on Thinkorswim, if you get my script, it will be off for you automatically. Oh, I forgot to share the script. Let me share the script here. Ooh. Share second. All right. Team, you know what the only issue with this live session is? It's not longer. Okay, I'm kidding, but I honestly can't wait to teach all of this stuff, especially when I get some sort of rhythm on how I want to teach it. But yeah, team, do you know okay, never mind. We took the example off. But yeah, that was another thing to also discuss about. Oh, perfect. Yeah, you're good, Chuckles. Yes, sir. Team, here's QQQ, okay? Here's QQQ zones, and you can see the way that I've been trading these zones. Like, same thing over and over. Same thing over and over and over. I've been trading these zones. And you know, you can see like once you get a for this particular one, like you see how we kind of had like a breakout and then we fell back in. This is what I say, like as soon as you see that massive red candle, I just want you to cut. Okay, please, I want you to cut, because I don't want you to be holding in hopes that it's gonna go back up. You know, no, man, no. If it breaks down and you see the next candle's kind of opening red, cut the hell out of it right away. You know why? Because we're going to cut it, right? We're going to go into observation mode. And look at this one. This is very tricky. If someone had cut and they got back in, they actually got trapped again. But, you know, sometimes it happens. But if you are a disciplined trader and, you know, you're not trading the fake out, shakeouts, the emotional part of it, and you're focusing on the good parts, in majority of cases, when you get a breakout, price action is going to be very clear about what it wants to do after that breakout. Let's draw the zone here, right? After the breakout. And anytime a breakout happens, anticipate another zone to take place just above the breakout, which will trigger in the following days or in the following candles to basically rip. And you can see like once they get a breakout from the zone, they came back up halfway, which is the thing that I've been teaching you guys. If you see that the candle's holding up somewhat, that's fine. You can wait for the following candle to see if they're going to take it out. And if they take it out, that is confirmation that momentum is there and that they're going to undo the sell-off and they're going to trigger the actual big move. This operation here is the shakeout. You can see traders were shaken out based on the volume before the massive breakout. So this does happen. And that's why I'm saying, like, even if you decided to get shaken out, that's perfectly fine, because as soon as you see a bullish engulfing candle like that or a bullish engulfing candle like that, that is your confirmation to get back in. So that's why we are going to study the candlestick patterns too, because you want to know when the sentiment reverses. So even if weakness shows here for whatever reason, it could be news related for all we know. But the question is, how are buyers going to step in once they get back above the zone? So once they got back above the zone, if I extended there, you can see once they got back above, they clearly showed, oh, I'm going to take this red bar out because that's, you know, it's bullish. You know, that's simply what it is. That's the momentum right now. And that's why this move does this. The stock moves the way it does. And team, here's here's something else for those of you in here. Going forward, don't trade the opening market session, okay? Avoid trading the opening market session and always trade an hour, 45 minutes to an hour after the market opens, all right? 45 minutes to an hour after the market opens. And here's why. If you would have traded QQQ today, when the market opened, you went from 366. And keep in mind, if you're buying a 0 DTE, even if price action gets back here, this is useless to you. Even if they got back here, your contract still expires worthless, even if it's at the money, because, for example, let's take a look. So the 367, right? The 367 expired at 0.63. But do you know that even the 367 strike, although QQQ closed at 367.46, even that one really expired worthless. If that was in your account, they basically would take that value away from you. So anytime your contract expires worthless, sometimes they may have value, right? Sometimes they may have like $43 value or something. When they have that, you better sell it because it's going to lose that value too. So even if the market opens, even when the market closes, 4 hours later, that's going to go to zero. Like it's going to say zero after. So make sure you watch that. So if you were holding SPY there, 367 call, that's going to say zero. So this is what I mean, team. Now let's take a look. Let's take a look and actually illustrate this into the live set, into what we mean. So let's say you were a trader who traded the opening session, right? If you entered when the market opened, the contract was trading at 0.72. An hour later, which is when I want our team to trade it, the contract was trading at 10 cents. Are you guys seeing this? Are you guys seeing why I'm telling you to avoid trading at the opening session? Because when you trade at the opening session, theta is still priced in. All of that is priced in, and once that sheds off, this is what happens. You're gonna have the option go from 0.74 down to 0.09. That is crazy value loss. Like, that's devastating options. And then from there, what do you see, team? From there, if you would have entered anywhere from that reversal by drawing the zone that Rainbond showed us, by the way, I was not comfortable. However, when I saw Rainbond's chart, although I have the same things, because of the things that she had drawn on there, it made me confident to want to get into SPY. And also because, I started seeing the shift here, and we both got more confident. And this is the zone there. So let me just remove that. That is the zone, right? So let's say that we entered anywhere around the low of those zones. We went from 0.09 all the way to 0.33. Even though the option expires worthless, out of the money, the option had a 300% move, because we entered at the right time, which is the time that I'm telling you. If you wait an hour to an hour and 45 minutes to an hour and 15 minutes after the market opens, your chances are going to be exponentially higher in being in profitable trades. If you don't believe me, test it out, and then come back to me and tell me I was wrong or I was right. If you guys are wondering why I'm wasting time, a lot of times it's because, like, obviously right now the market's terrible, so you don't even want to even trade the opening session. But in most cases, when markets are in normal conditions and not at peaks of it, you're gonna have opportunities to basically catch it at the opening session as well. Let's take a look at another strike, okay? Let's take a look at the 366 strike instead. All right, team. sorry, the 367 strike, which closed at the money, but it's still gonna say it's still going to take money out of traders' accounts because it expires worthless. That's what it is. Sorry about that. Now, team, I want to show you for this particular example, for this particular strike example, I want to show you the difference between choosing a better strike and a less unfortunate strike. Sorry, and a less fortunate strike. So you saw, actually, I'm going to pull the other one up too so that we can see it. All right, so this contract, the 367 strike, right? Sorry, the 368 strike. The 368 strike, that one went from 0.09 to 0.35, okay? So it's about like a 300% move, right? However, if you look at the 366 call, which is one strike in the money, you could have paid a bit more for this one, right? So keep in mind the low of the other one was 0.09, and that was a very rare occasion. You could have caught it maybe at 0.11 or something. Now this one for 20 minutes, the option was trading at 0.17 to 0.20 area. However, this option, you can see it went from 0.20 to 1.4. So this one went up 500% compared to the other one. Do you guys see what I'm trying to show here? Choosing the right strike is everything. Just remember that for the future, team. Choosing the right strike is everything. This one in particular went up 500%, while the other contract not only expired worthless, but only went up barely 300%. So choosing the right strike is everything. That's for short-term expirations. By the way, Kevin, the reason why I was so confident when you asked me if you said that the zone was a bit off, and I agreed with you there that the zone was a bit off because if you look at today's price action, right, on the 2-minute time frame, sure, it looked like a zone, but on the 5-minute time frame, it kind of looked like a kind of like a slow sell-off, you know. So I understood what you meant when you said that the zone was kind of like, I guess, complicated, I would say. However, what the reason, something else that had me confident on SPY was also the RSI reaching 11%. When the RSI reaches that low, man, it's going to bounce. And you can see, like, even as price was going down, the RSI was showing a clear bullish divergence, and that triggered some nice upside. You know, it went from 437 all the way up to 440, which is not bad.
Gotcha, because retrospectively, we caught it at the very bottom.
Yes, sir, we did.
My
Yeah.
oh my, caught it right at the very bottom. And that, I mean, how many times does that happen ever? 1 in 100 times?
Yes, sir. And
Not frequently.
honest to God, Kevin, like we're going to do that. Um, um, like we're going to see that probability increase, and who even knows, maybe even compound, man, to unbelievable realms, like years from now. The thing is, you guys, even myself, I just barely started learning this stuff. Supply and
Uh-huh.
demand zones, like that was my weakness. I thought this was like rocket science, something I could never figure out. And um now the more I learned, especially with time, the more and more and more I'm starting to notice, and even things on my own that I haven't learned anywhere in the book, such as like the halfway pullback and so forth. Like all of that stuff, we are applying it based on our experience.
Yeah, that turned the day around for me, and I know others too.
including myself, Kevin. Same with me. I swear to you, man. I made 250 on that trade. I made 250, and then
Okay.
that's why, like, before, if you guys, like, when I was sharing my account value
Excuse me.
before we recover, before Apple, which was I was in Apple and AMD, before those
Yeah.
two stocks recovered, I was already like so close to touching the green for the session, and that's because
Mm-hmm.
of the SPY trade that we caught at the bottom.
Yeah.
And NKE was another good one.
Can you hear me, buddy?
Yes, we can. Hello, Rainbow.
Hi, I do just want to mention, I know the base was a bit off on the 2-minute time frame that we traded today, but I was confident on that trade because so basically, as I mentioned, if you read my market analysis on SPY, on July 2nd, sorry, let me just breathe. I was running. Okay. Yeah, so if you read it on Discord, I did say that if we do fall back below 437, that's the key support. So that's literally the level I have that where bulls can possibly try to hold, because as I have a chart right here, but I can't show it. I'll post it on Discord. That was 437 level was the previous breakout. That's where we gapped up big time to 440 to 444. That's why my level was basically
Wow, I see.
yeah. If you I'm gonna go ahead and post it on Discord because I don't know how to post it here, but you will see it there.
Perfect. Thank you.
He said he called the hospital in Chattanooga
By the way, team, we are going to be signed out in 6 minutes from now.
after 2 hours of deliberation.
I appreciate your time. I really do.
Is that Chuckles?
That is Chuckles.
Thank you, sir. Thank you.
That's quite the experience. I've got quite a few years trading, but not on this level. I've learned support and resistance, but not to the intricacies that I've been introduced to. And my understanding of it in the last 2 weeks has been turned upside down. So it's a complete different world. I see things differently as far as trading is concerned at this point.
That's really awesome, man. I am so happy to hear that. I'm so happy to hear that, man. That's great to
Same here. I
hear.
wish I'd met you guys like a year ago.
Yeah,
Oh,
no,
man.
I blew up a huge. Well, for me, it was huge. I took an account that was $3,500 and I pushed it up to about 33,000, and I completely blew it on zero DTEs and just being basically gambling.
Oh
And
my God.
yeah, it was ridiculous. I had kind of melted down. I took a year off. I got back in last year with my regular TD account. Started with 5 and I've pushed it to 16. But then I'm trading on a Webull account with you guys. So kind of I do my own thing, but I also very closely follow what you guys do. I don't necessarily do everything, but
I love it.
I take a
Actually,
look at everything you guys are doing too, and I analyze everything as much as I can. So
yes, that's exactly how personally, that's exactly how I would prefer our team members to become. Matter of fact, I love that you sometimes even share the positions that you get, because like, I swear you guys think, oh, like, you guys buy stuff off of me, but the crazy part is I buy stuff off of you guys too. Like, when I see you guys sharing something, I get into that as well. And I think this is really awesome, because we keep each other. By the way, I really want to share this with you guys. My trading has changed so much ever since I started, like, doing the live sessions with the team, and just spending time with the team for many reasons. Okay. One of them was, I don't put myself in zero DTEs because I can't afford to be down and bummed out because I did something stupid. I have to
Yeah.
teach. And if I'm going to teach, I have to be an example myself. So I swear, you guys, ever since then, I have been doing so amazing, so amazing. And it's all you guys to thank, because you guys encourage me, and you guys, we as a team collectively encourage each other to trade better.
That's I noticed you overlaid options contracts onto the chart, and I'm playing with TOS right now looking for that. That was cool.
Oh, it's very easy. You go to, you see, personally, me, like I use only two, I use charts and trade. That's about it, really. Maybe sometimes analyze, but chart and trade. So when I go to trade, also one more thing, like if you go back to charts, Chuckles, you can connect, you see this one right here. Make sure it's yellow. And when you go to trade, when you click the trade tab too, make sure that box is yellow as well. The reason why is because anytime that you're typing a stock, you're looking at a stock chart, and then you want to look at the option or you want to trade it, you can go to trade, and then it will instantly connect the same chart that was there, and you will see all
Okay.
the options down here. So let's say we are going to look at um let's say we're going to look at August 18 for the 427 call. Let's go to the August 18 427 call for SPY. And then you're going to click on the right side of the chart, and um, the second one to the bottom. There's the second one to the bottom where it says more info on SPY.
Yeah.
You're going to open that tab, and then TOS charts, which is the third one to the bottom,
see
TOS
that.
charts, and then send it to the second window. So the upper second window, and that'll send it there.
Got it. Thank you.
Yes, sir. And you can look at, I would honestly like, for very, very liquid options, you can look at them on the short-term time frame. But mostly what I like to look at is, like, I like to see the volume. I like to see, I just like to see, oh, you know what, Chuckles, this is going to be a game changer for you. You know why? You like those long-term contracts, which a lot of
Yeah.
them, like, you can track their movements. Um, for example,
That's how I've been
HD.
playing like CVS. I'm kind of stuck on that. I can't get away from it. I sell it and then I go back, watch for a dip. I buy it back up.
I
A
see.
lot of times I'm buying it for less than I sold it for. It's been a nice little rip.
Awesome, man. Awesome. And the big move hasn't even happened. We're still in a
Nope.
we're still in a range.
Yes, sir.
Let's take a look at January. So for example, you see this option chain here,
Yep.
Chuckles, for 75 call for January 19. This one, like, I can see it as far as 2021, which is just insane, you know.
Mm.
And it shows me, like, if I want to know what the 75 call for January 19 was trading at on this day, I can look at it here and I can be like, oh, it was trading at 4.0. So the fact that this is a January call and us going there is like 470 at the top, which is just a $2.5 move. My God, this is a great contract.
Mhm.
I
I'm holding
also,
the it's a 70C. I bought in the money. At least
oh,
at the
okay.
time it was.
I see.
But this one's for November.
Oh, that one's for November. I see. I'm
Yeah.
looking at the January and I'm liking the January. Oh my gosh. I'm really liking this one.
I also just want to mention that this is really good for scalping too, Chuckles. So if you look at, let's say, like a 0 DTE contract, or even if it's a weekly, you look
Sure.
at the chart or your contract and your chart together. It's really, I've done it, and it's a really good scalping strategy for like a few, like $20 to $30 scalp.
Okay. Sounds good. Thank you.
So, if we look at the CVS option, we can see, team, like that one, the 70 call, that one's freaking cheap, man. Like that one's trading at the very bottom, and it was trading at um $2,000 when it was at $89, so that's a really good contract. Well, I personally, I mean, it's good that it's in the money, but I would only buy that for my account. The reason why is because I know my account is big. But if someone has a small account, I wouldn't recommend you taking a $500 risk, especially in case the position does go wrong, where you can't really do your usual trading to grow the account. Small accounts don't have the freedom that the bigger accounts have, because um, the funds are everything to you at that point.
I think between both of my brokerage accounts, besides what I trade, I throw about $1,000 a piece into each one of them every month. Just to
I
keep it
see.
going, keep my liquidity. And I buy equities and hold just the same.
I'm thinking about some I was thinking about a strategy today where uh um for that particular channel, I'm thinking the channel will have only two or three unique strategies, and the strategies, they don't happen all the time, they happen rarely. And um one of them is like, you see how we saw NKE today, like NKE at the bottom, and we knew that the stock was going to get some upside because it was clearly showing strength. And we had a beautiful bullish engulfing candle there, a beautiful bullish engulfing there. So once we saw that, what I did was I bought like 10 contracts or something, and I made 200 $230, sorry, 250 or 270 or something like that. And when I sold it, I made one contract free that expires all the way in January 19. So the strategy that I want to do with our team is I want to do that so we can get those long terms and just kind of let them run. Because some trades will be such a high probability. The reason why this was such a high probability is because look at the absolute sell-off. I mean, the RSI on the hourly time frame was trading at 12, man, at 12. So something like that, we can add size, and we can basically, as soon as it goes up, we can sell basically even all except one, and just let the other one run as we would with a normal trade. Let's say we enter one trade. So by the end of the day, before the market closes, we want to be out of the other trades and just keep one overnight. I think this will be a great strategy for us. I forgot what the other one was, but the other one was, if we make money, let's say we make $250 on a trade today. What I wanted to do is I wanted to get the team to be buying long-term assets, turning them into long-term assets in that particular channel. So there's going to be a dedicated account where we will take very defined trades, right? We're not going to just go in there and take speculative trades. No, that one will have very defined trades. And the way that we will do it is we will what was the strategy? Well, one of them was this one, and the other one, oh yeah. So we would basically do a trade, and then it would be a day trade. And then once we make the profits, we would turn them into, let's say we buy NKE at $105 because we made $105 on that particular trade. That's what I want to do for us. Like for that particular channel, I want to do like 3 strategies that I will use over and over, and it's going to be something that focuses on building cash for the long term, like something that short-term options are not going to take away. And that's like shares, shares of companies. I think that will be so cool. Imagine like we start picking up all these random shares on the account, like NKE here and then that there and then that there. And then what you could do is like, for the future to make it even, I mean, I don't think it'll be confusing at all. Honest to God, I think it'll be a wonderful challenge, and I'm looking forward for that. I'm going to implement it into our Discord.
And I remember being emotionally just in turmoil.
Hey, Bobby.
Hi, how are you doing?
Good, good. Yeah, I had a question on the long term, the leaps. On average, how long do we end up holding on to those before we see, you know, a time to jump out? Some
Honestly,
profit?
it really depends. It really depends on the traders. Like sometimes you can get in and you can just you can sell as soon as you hit 20%, and if it dips again you can buy it again, and the way that Chuckles is doing. And then another way is you can buy, or not only that, like you can buy and then you can target a longer term return, because you have the time and you can weather the consolidations and even the pullbacks. Now there are strategies that you can combine to make them both, to meet both. And one way is you can buy one, and let's take a look at an example here. So let's say you bought NKE back in let's say you bought NKE here, right? Let's say you bought NKE here, and then NKE went down a little bit more. Sorry, no, that would be a bad example. Let's say something else. Okay. These are nothing like real examples that we would dip buy on. Okay, you know what, team? How about this? Let's say we entered here, okay? Let's say we entered on that and then we got faked out. Let's say we had a long-term position and we entered ahead of time before we reached support. Let's say we entered at 108 on NKE, right? If that happens, where we sell off and we lose like 60% of our long-term positions that expire like 8, 9, 12, 15 months from now, what we can do is we can average down another position down here. And as soon as we get a move back up right here where we are big up on both positions, we can close out one of the positions, and then this can pull back short term and you can just be at ease and not sell, so that you can catch a huge move like that into the future. And that's where you would want to sell. Like you would want to sell once you get a huge move. To further answer your question, the way that I want our team to trade these contracts is the way you would trade stocks, right? If you are happy with the profit, secure it. Why? Because we are going to do them over and over and over. But the way that I want our team to trade it is the way we are trading these stock options is the way we would be trading stocks, but we are getting the benefit of options. For example, how often do you see a stock going from $400 to $700 in 2 days or 2 weeks? Not often. And that happens all the time with stocks. Even on the crappiest stock, it happens. And that, especially if you buy them at the right time and at the right place. So it really depends on your preference on how you want to secure profits. However, I will provide you many strategies that will be in betweens where you can get a little bit of both. You can even turn sometimes off, sometimes bad entries. I wouldn't say bad entries, but entries that aren't in the best place, to turning them into entries at the best place. So we're
That's
going to take
probably my biggest problem is identifying entry, but that's where the zone boxes have changed things,
Yes. Oh my gosh. That is exactly that. That's the like the core function behind this strategy. The core function is, one, we know that smart money is going to enter because the algos, the levels are broken. And the second, because of what you said,
Non-talking A.
it helps with very, very clear defined levels for entry, even stop loss. For example, if I'm going to have a box, right? Let's find a box. Let's find a box real quick. Let's say NKE right here. I'm going to draw a box on NKE. This is going to be my box on NKE going into tomorrow's trading session. Okay, team? Since we are getting a retest here on NKE at the top of this base, if we don't get a breakout and we come back down, we reject the zone here, the top of the zone at 105.39 and go down to 103.67. If we go back down here, I'm going to enter on a bullish candle because they will have, that's a potential double bottom, and if that is the case, I'm going to have my stop loss slightly below that at, let's say at 103. And if they go below that, I'm instantly out. Matter of fact, you can even, let's say this is your zone, right? And this is where they placed the reversal. So I'm going to delete this one real quick. And let's say that they placed a green reversal there. If they placed a green reversal right at the retest of the demand zone, you can have your stop loss very clearly, very confidently, and very, very minimally at the break of the zone there, at the low break of the zone. So sorry, not the zone. I'm so sorry. Of the demand candle, of the reversal candle that you are entering. So even if you're trading inside of the zone, you can do that. You can have your stop at that demand candle breakout. Team, I just want to say this. If you as a trader wanted to minimize your stop loss, I swear, man, if you go through the course, there are so many strategies that you will learn that's going to help you minimize your stops, because like one way is like the demand candle. If they take out the demand candle, there's no reason to be in it because we entered because of the demand candle. If they take out, let's say they get below the zone, I have already told us I don't want us to be going in, like I don't want us to be going down with why are we going down with the trend and like hoping for the best when we can just get back in. I'll show you how we're going to get back in. Okay, team, let me draw the candles first. So I don't want us to be in the trade and then hoping for the best and praying that we're going to get a reversal eventually like that. I don't want us, if something like that happens, right? If something like that happens where we break down and then like this candle's like showing weakness here like that, like clearly showing weakness, just exit, team. Just exit, get out of that trade. And if anything, I want them to crash it the hell down if they wanted to. Let them crash it as much as they want. If anything, when do we get back in? We're going to get back in. Obviously it may not, well, it's going to drop honestly like that once there's a confirmation. But what I want us to enter is when we see something like that. When we see something like that, a massive bullish engulfing, that's when I want us to enter. Once this happens, team, I want you to like, the one of our members shared the meme, the GIF or the emoji that says take my money. When this happens, the bullish engulfing happens, that's what I want the team to do, because as soon as that candle happens, oh my God, they're gonna go back up faster than the speed of light. So that's why, team, I want you to cut. I beg you to cut. I want you to learn early on to cut so that you don't have to. And here's the benefit of cutting, okay? The benefit of cutting is it takes your money out of the risk, right? It removes your money out of the risk, and then it puts you into observation mode. And then on top of that, it gives you a better entry. So if you still were confident, but you expected some fake out, shakeout operation because of whatever key level lost, then you can enter whenever that shakeout operation comes to an end or loses strength. So you could enter like at the bottom of here after you cut losses down here, which is a major discount. Another way is like you can enter, you can go into observation mode and you can re-enter as soon as you see that massive bullish engulfing candle, or one of the strong bullish engulfing reversals that we have been discussing. And one of them that happens 90% of the time during these reversals that I want to see in these zone regains or whatever is this one right here.
Stony is a same question as I actually have. Like, would I typically wait for a second green candle confirmation before I enter? Is that something you would suggest?
You definitely can, but I will say like a lot of times you will also miss out on the move because they're just, like I said, they're going to take it up there at the speed of light because this is such a high probability confirmation. It's like a clear bear trap, it's a clear bear trap. This is not supposed to happen, but of course you are 100% right. They will do it in this way. Like I'll show you. They will do it like this, where first you're gonna see a red candle, and then you're gonna see another big red candle. And once that happens, my God, this is so bearish when that happens. This screams death. This is very bearish when that happens. So when that happens, you instantly want to cut. You don't want to have any emotions. You don't want to be like, oh no, I'm going to wait and they're going to revert. How? I've never seen a pattern like that reverse, they always break it down. So, that's why confirmation is very important. And I love that you guys wait for confirmation, but I do want to share another strategy where this one you have to cut, man. You cannot not cut. You have to cut if they go lower. Here's the strategy. You guys ready for it? I catch it every single time when I want to have a minimal stop loss. All the time when I want to have a minimal stop loss, this is what I do, okay? First, I wait for the bullish engulfing reversal or whatever reversal that shows up, right? Then I know that they're going to have a retracement because of the certain market condition that day. I know that they're going to have a retracement, but I also know that this retracement is going to turn into something like that. Sorry, team, give me a moment. It could turn into something like that. You guys see what I mean by that bullish hammer? So that's why, sorry, not like that, like that. And once you see that, team, that is extremely bullish. Like once you see that they regain that, this is extremely bullish. So sometimes I re-enter early. I re-enter when that candle was red. The way that you guys saw it, it was red. I re-enter on that on the 50% retracement. Like 50% is right halfway to the candle pullback. I enter on the pullback, and then I wait for that candle to turn into like that. And then once that happens, it's nothing but rocket mode from there. You're going to see something like that. And from there, it's over. They're going to consolidate a little bit, whatever they're going to do. But what they're going to actually do is hold support here and just it's predestined to hit 105 as soon as it regains it. Now, team, when I do this, what is okay? I would never do this unless I had the stop loss rule that I'm showing you here. So if I did that, right, if I entered here at the 50% retracement, like my entry was somewhere down here, like halfway here, I am minimizing my entry compared to someone getting a confirmation all the way up here, right? So instead of me entering here, then if I enter, my stop loss has to be you cannot take this part out of this trade setup and have the strategy work. No, it's going to, I need you guys to do this. You have to, because that's the strategy. If you miss this part, you're it's not complete. The equation, you're not going to solve the equation. So just look at it this way. If you have your stop there and you entered on the retracement, you're only giving it this much. You're giving it this much for this whole thing that happened to either work or not work. And that is the beauty, you guys. That is the beauty. So whether you're seeing it happen on the weekly time frame, whether you see it happen on the monthly time frame, if you see something like that, the retracement, you can enter with your stop loss very firmly at the bottom of the bullish engulfing, 1 penny below the bullish engulfing candle.
While working at Bear County Hospital in San Antonio.
Team, thank you so very much for being for attending the session and being in here. I'm looking forward to to Tuesday's class. This class, although it was our first, it is not the official first. We're going to go over the materials again tomorrow, especially the supply and demand zones. We're going to start off from the supply and demand zones and cover everything else from there. Because I was a bit nervous today and all over the place. So, but team, I promise you, we are going to learn so much. You have 2 hours. You have 2 hours every 2 days, or every Tuesday and Thursday with me, and I think we can share so much. So thank you so much, team. I really appreciate the nice comments. Thank you guys so much for being so supportive, and I'm looking forward to tomorrow's trading session. Let's have a great closing session for the week. And I'm really excited, team. I'm probably going to do another session like that where we will do several hours of live, like after the market closes, especially since it's Friday. We're going to have another several hours of live session in the Discord so that our Discord community can also benefit. And I'm going to really share as much. Team, let me show you some stuff that I want to share that we haven't even got to. Before we go, I just want to show you this real quick, okay?
I love it, man. I love it.
Check this out, team. You see this right here? Look at all this stuff. This is all from Core Strategy. I've taken all of the good stuff that I need to teach the team. And I cannot, look at this right here, team.
You don't mind if I screenshotted that stuff, huh?
Oh, go for it. Go for it. We paid 50,000 for this, man.
Well, I got
It's the
like
least we
18
can
bucks
do.
on that picture now.
Oh, you know what? Team, what did we just talk about in terms of stop loss? Do you see what I mean? Right here in the example, they're showing it too. This is your risk. The low of the candle is your risk, and that is all your reward. So that particular trade strategy that I showed you is something like that, but with a much stronger reversal candle. You guys are so nice, man. I did so bad, and you guys are so nice. But
Oh,
I
man, it's good
swear,
stuff.
I
You're-
got you. Thank you.
I appreciate you, man. I'll see you guys in the morning.
Take care. Take care. Here's another one if you want to take screenshots. I got more.
Yeah, I'm about it.
This is another one. This is your proximal line retracement on demand zones. So if you were trading demand, keep in mind, team, you see how we are trading demand zones on a bigger picture. You can trade the demand zones within candle by candles. Okay. So this is how you trade them. Now let's pull up more. Let's pull up more. Man, I got so many of this. This is during downtrends. This is during this is a supply zone. The one you took was a demand zone for candlesticks. This is a supply zone.
Supply zone. Good stuff, man.
Yes, sir. Team, this is not it. I'm like that Oxy commercial, the one the the detergent guy who kept saying, wait, there's more. This one is a trend formula. So I got us even on trend formulas, like literally on trend formulas, which one is poor, which one is best, which one is, good. So this is the zone. Yes, sir. We there's trust me, guys. We're gonna cover a lot of that, like all of that stuff. Actually, oh, we haven't even got to high on the curve, middle of the curve, low on the curve. We haven't even covered that stuff. We're gonna cover all of that. Higher time frame zones, lower time frame zones. Um, what is this one? This is a cell setup, team. This is a core strategy cell setup. So when you come back down and you retest a supply zone, this is how you do it. This is a trend. This is a trend stage and entry decision matrix. So if you guys want a decision entry, for an uptrend, you buy at the demand zone, let profits run. Oh, wait a minute. This is going to help you because you said you didn't know where to take profits and everything. This is another formula that'll help you. So team, the things that I was teaching you earlier where we buy at the demand zone and so forth, this you can also combine it with this stuff. I mean, we buy the breakouts, so forth. You can also matter of fact, team, I will show you how you buy at the demand zone, how you set your entry. The way the 50,000 course, the class, they're going to basically they're going to teach you or show you how you set your entry ahead of time. So that's exactly what we're going to learn in tomorrow's trading session. In the live session, I'm going to show our members how we're going to buy at the demand zone way ahead of time. I mean, sometimes like you guys see that, we'll talk about this more tomorrow. So tide base, look team, look at this. Oh my, what the team, do you see this? Look at this. This is something that I wanted to talk about, but I was like, it's too complicated. I don't want to share with the team yet. Look at this. If you have a tight base like that in the zone, you wait for a breakout, okay? And then you let profits run. But if you have a very wide base, right? If you have a very wide consolidation base, you can buy low, short high, sell high, cover low. So basically, it's telling you that you can short at the top and you can buy at the low because you're in a wide zone. But if you're in a tight zone, you can wait for the breakout. My God, I love it. I can't wait until we already have studied some of this stuff, but the more details, the wide, the tight, all that stuff. Oh man,
Eastern
all
property,
goodies.
Picturesque downtown. and
Oh,
colonial
team, this is a 6-step process on trading your plan. Sorry, on taking your trade.
They can make more money than New York City.
If you want to take a trade, man, you guys are too awesome. Kevin, Stoney, you guys are way too awesome, man.
And so it's been a magnet and easy access.
And with the drug traffic has come an increase in.
Team, take a picture of this 6-step process, and we will talk about it. We will talk about this later on. But this is also amazing. These are each steps. The pre-steps are you set the curve, which is a supply and demand zone, right? Then you check the trend, which is drawing the trend, right? And I swear, I even had ChatGPT organize me these whole steps. So I got all of these stuff for you guys. You check the trend and then you identify the zone, right? After that, you give it a score for the trade and then you set your trade. So sets is a formula for your trade, which you took a screenshot of earlier, and then you place your trade. During the trade, you're managing the trade, you're monitoring reports, and after the trade, you log the trade so that you learn from the, you reflect on that trade. So, also team, here is combining trend and zone. So, this is going to be great for My Oh My got off earlier, but this is something that she will, because she's to the point where she's understanding the zones and so forth. And I think, and she's understanding trends. And I think this will help her greatly because it shows the formula. So if you have a trend direction indicates whether to go long or short. If you have an uptrend, you're going to be buying you're going to be buying to go long. So in an uptrend, you're going to be looking for demand zones. In a downtrend, you're going to be looking for supply zones to short. in sideways trend, you're going to be looking for demand zones and supply zones because you're going to be trading the inside of the zone. Trends tend to continue. Proper trend identification also shows the location within the trend, within the breakout segment. Trust me, this may be hard, but the way I explain it, just watch, team. Well, I'll show all of this for the next session. I have it on the Google Docs file.
As we canvass the neighborhood.
So, team, the 6 steps that we talked about, this is step 1, and I have all the other steps one by one. This is just step 1. So that's going to be all for today, team. I don't want to keep you here for too long. I hope you all have a wonderful rest of the day. Here's more of the steps to show you better. So you can see this leads to no trade if it's weak. If the score is weak, no trade. If the score is good, then you take a trade.
Mayweather standing at Kathy Sagasti denied any knowledge of Macaron's.
I had some other good stuff. I have a lot of good stuff. It's just in different folders that I gotta put together. But yeah, team, I got some real, like, oh my God, look at this, look at it. Look at this one. Team, they're literally showing you zones, man. They're showing you demand zones, higher time frame demand zone. They're literally showing you demand zones, which we are studying. It's like this right here. Isn't that something that you guys recognize? If you look at this right now on so many things, ABBV has this right now. If you look at ABBV,
Pull it up.
this one's the time factor, team, for the supply and demand zones. You see, the less time spent at a supply zone, the stronger. The less time spent at a demand zone, the stronger. The more time spent at a supply zone, the worse. You know why? Because it slowly absorbs all of the supply or all of the demand at that zone. So that eats all of it off, and that's not good.
Inside the dead house at the time, there was a.
And that's
Thank you,
basically
Kevin.
what you're talking about when you're talking about, let's see, the liquidity grab.
Yes, sir. Yes, sir.
Okay, that helps.
Sometimes, like, if this is a support level, right? Like if this is a demand, a lot of
Yeah.
times like demand zones happen just at previous breakouts that turn into support. So when that happens and you're seeing a wick, anytime that you're seeing a wick, this is a liquidity grab, because at one point that wick was like, that candle was fully red.
Yeah.
So,
Yeah.
but then if you look at if you look at this one, like this one, it shows it's just too poor, because it spent too much time there.
Yeah.
And I will show what I mean by this, team. Okay, like
Wow.
let's take a look at SPY on the daily chart. Okay. For SPY on the daily chart, do you see what I mean by just one retest? Like all you needed to do was this one to retest. If this one right here, like realistically, all you would need, even if you just get one retest and you get a pullback, you should confidently enter, because that itself was weakness. Like you can see it anytime here. But then when you see like spending a lot of time, it's bad, because like, yeah, it can break down like that, but it can also go up like that, when it spends too much time.
Yeah.
But yeah, team, we'll talk about this more. We'll cover this more. For now, I will let us go. I hope you'll have a wonderful day. I hope to see you, Kevin, and everyone else in tomorrow's live trading session. And take care, team. Let's have a great day tomorrow.
Indeed. Have a good night, buddy.
Take care. Take care, sir.
Good night, all.
Good night. Good night, Mike.
Sometimes with serious infections, life-threatening lung inflammation, so your doctor about any